Well, dear colleagues, dear students, ladies and gentlemen, it's my great pleasure to welcome you today here at Roma 3 for this very important conference on towards Payment Service Directive number 3, the dynamics of digitalized payment services market. I have the privilege to address you on behalf of Dean Antonio Carratta, who was impeded by another commitment to be here today and apologize. But I'm also speaking as the Vice Director for International Affairs of this university. There are many reasons why we are particularly happy that this event will take place here today. And I would like also to thank Professor Bresciamorra and Professor Paglietti for having all put this together. First of all, from the perspective of the internationalization of Roma 3, I think that this event is a clear example of the presence of international network of research of a particular high level and value. Secondly, from the perspective of the Department of Law, we are particularly happy that they organized, our colleagues, this occasion of a discussion. We have recently introduced 2 new masters, one on bank and finance, another one on law, science, and technology, and this conference is exactly at the crossroads between the two. Also, we have been recently awarded the title of the Department of Excellence with a project on the digital transition, and again, this is an important step toward our project of research. And thirdly, as a scholar working on the digitalization and the datification of a society, I could not be more interested in this event. But I know that there is a golden rule for the welcoming address, and the golden rule is to be short. So I will not speak on the merit because we are all eager to listen to introductory remarks by Professor Zenkovic and to all the distinguished guests who will be talking today. There are many friends among them. I would like to say hello to Mads Andenas, Hans Miklitz, if he's connected, and to all the distinguished representatives of the institutions that will take part of this event. So thank you very much for being here. Thank you to the organizers for the organization, and I wish you a fruitful day of discussion.
Thank you, Professor Resta. I join my thanks to Professor Bresciamorra and Professor Paglietti for having organized this conference and having convened such an illustrious panel of speakers, but also of attendants. And I'm particularly glad to have the important role of our national bank, our Bank of Italy here present, and interaction between this department and institutions, all the institutions here in Rome, Italian institutions, and obviously also European institutions, is essential for our job. I'll do a disclaimer. I'm not an expert in financial markets. All those who will take the floor afterwards are much more experienced and have longer and more in-depth knowledge of the field. What I would like to try to present is sort of a fresco, a very small but a fresco, and not something very detailed. When the the second Payment Service Directive was conceived, it was over 10 years ago. In these 10 years, enormous amount of events have happened, and society and technology has significantly changed. First of all, just let me mention a few points which are in part already here, but in part are on the move. The first is that we have new knowledge of what, Europe of what data markets are. When the beginning of the last decade, the directive PSD2 was issued, there was this notion was not yet very clear what data markets were and what the importance of data are. Here, I would, if I can say something, put it rather bluntly, it seems to me that there is an awareness at a European level, but also at the national level, that data and financial data are a strategic resource of our countries and of our union. And therefore, they are not something that sort of should be opened, given carefreely. You know, we open the data and give it to everybody because data is, quote unquote, the new oil. If it's not the new oil, but if it were oil, we wouldn't open our resources, our natural resources, to anybody coming along, exploiting the oil and selling it elsewhere. So data is, from this point of view, similar to an essential and a strategic resource. So this is the first point which I would like to highlight. The second point is that as a result of this, if we look at because what happens in Europe, the European Commission is a benevolent Kali goddess, you know, the Indian goddess with 10 hands, 10 arms. And so one arm doesn't know what the other arm is doing. So the sort of financial regulation arm doesn't know what the digital market arm is doing. And the digital market, if we look at the Digital Market Act, we see that there is a significant restriction on access to data and the use of data in the field, especially the risk of monopolizing this data. And so this will bring us to a second point. Further element that has significantly changed over the last 10 years, the fact that the banking, when it comes not only to consumers, because surely the Payment Service Directive has to do very much with consumer protection, but in general, with payments is absolutely open banking, home banking, digital banking is absolutely common, and a great deal in most countries. Everything has more or less moved from sort of a currency, a coin, a paper-based payments to digital forms of payment. This changes significantly the environment, and this means that we have to look at not what was, you know, something that was happening at the beginning of the last decade, but something that is already here, and therefore the fact that all payments, nearly all payments, are digital, this brings us to reason to see the sort of evolution of the regulatory framework, see it in a different way. And this brings to a further element, the fact that we have new systemic risks. If one looks what happened in the Silicon Valley Bank, or even in Credit Suisse, the crisis was a crisis of liquidity. The fact that anybody can withdraw, I mean, I want to withdraw everything from my bank account, I do it, yeah. As soon as I finish surely to someone, I look in someone who's panicking, and I see that my bank is somehow in bad shape, and so I just remove it. I take out my money and put it somewhere else. And this is what happens. So when we start reasoning on the very complex financial environment, and how we should somehow protect our financial markets, and therefore the whole issue of prudential requirements, surely the element that now operations on banks, everything is online. I think this, when we start reasoning on the Payment Service Directive, well, we should place it in this system where this is something very, very simple. And when we look at stress tests, and we are we should sort of think of not only of patrimonial requirements and patrimonial solidity, but also the issue of liquidity, which is a very significant aspect. The third point is what is in the pipeline, the fact that there is sort of a project which is moving ahead as with the time that is required, with very careful attention that is required by European institutions in this field, the project of digital euro. And so this clearly has a significant change in the whole European financial market, and the shift of having currency move from paper to official currency, the euro, moved from paper and from coins to digital currency. Well, this will have a significant impact on our payment services. So having said, these are things that are a few things that are have already changed and are changing over these last decade, and will be changing in the near future. So coming to the ideas of reform of a payment service directive number 3, I'm just wondering, one always goes back to Hollywood, and there's a Rocky 1 and Rocky 2, and so the sequels, all the sequels. So I'm just sorry, I'm trying to make sort of a rather complex question to make it, to lighten it a little bit. But I'm just what I tried to do. I went to the prequel. So I started looking at all the documents which were preparatory to PSD2, and sort of how the environment was envisaged. And I must say that it's not my personal sort of point of view, but if one looks at the conclusions of the study on the application and the impact of Directive 2366, the very lengthy, they're sort of 188 pages. If one only looks at sort of the last 10 pages, which tell us what are the conclusions of this report on how the PSD2 worked or did not work, there are a few lights, but there are many, many shades. The first shade, which is significant and which must be, I think, avoided at all costs in any future regulation. What happens is those who are familiar with EU legislative process, there's a whole lot of papers that go on and so on. And then there's an impact assessment. When there's a proposal, we have two documents, impact assessment and a financial assessment. And if we look what actually happened after PSD2, these impact assessments, the impact assessment and financial assessment, were sort of rather, well, they were not at all confirmed. As a matter of fact, the financial assessment, which only said how much will this cost for the Commission, and it would cost less than $1 million to implement the PSD2. But when we look at the market, if we look at the assessment, what it costs for the industry, API development, 3.2 billion. Security, advanced security control over payment systems, the fact of authentication, advanced authentication, 5 billion, and an increase in transaction failure rates, 33 billion. That means 40 billion. So, I mean, obviously, I have no relationship with the banking sector, and I'm not here to sort of defend the banking system. 40 billion euros transferred on the banking system are something that has to be, when we think of a reform, well, I think we should have a more detailed analysis of what actually these proposed reforms will actually cost the system. I repeat, we are as citizens, as consumers, we are very concerned on financial stability and on prudential regulation. So we would not like that, when, as one says in Italy, that the sort of all the cemeteries are full of the graves of Mr. Good, who's been murdered by Mr. Best. And so I would not like that, that having to have going too ahead, then we have there are some negative outcomes. There's a final point that I would like to, and I mean, there is a further issue that comes out from this very lengthy report on the assessment on the impact and on the cost of PSD2. The fact that obviously we have to put this PSD2 in the background of Directive 575 on prudential requirements for the financial institutions. Now, this text is, I suppose, Professor Bresciamora passes her nights in wandering in this maze. It's 800 pages. Now, I mean, 800 pages is 800 pages. And if you start putting sort of a 100-page directive is 2366 is around 80, 90 pages, 100 recitals and all the rest of the articles. You try to put this within this huge context, you realize that the administrative burdens and legal uncertainty is very, very high. And so I think also that if one maybe sort of PSD free should really be somehow to cut, and this comes out from the proposal of the European Banking Association, to cut a few elements which are parts of the PSD2 which are not to the point, no longer to the point. There's a final issue that I would like to raise. In all these papers which I've seen, there is a blind spot. And I think this is a blind spot which is particularly important for consumers and businesses. The fact, the blind spot is all the payments that go from the private sector to, from private individual to private sector to public institutions. They can go from a parking ticket to taxes. Just think of the amount in all our countries of the money that goes from individuals to the public, to the treasury, or to national treasury or local treasury. Could be very simply something that you are paying for some hospital services. It could be anything. Just think of the amount of monies that we pay as individuals or as businesses and that go to the public. This does not appear to be, of at least I have not seen, a significant concern, and in these various proposals, while owing to the sheer amount of these sums, we are talking of trillions of amount. If you calculate over 27 member states and over 1 year, you think of all the monies that go towards from citizens and businesses to the public sector. I think this should require a certain amount of attention, and especially to the point, and here I come back to the consumer protection issue, the fact that increasingly somehow there's this principle which is, I think, should be, from a theoretical point of view, but also from a constitutional point of view, should be rejected, that you have to pay to pay. So I have to pay my taxes. I have taxes, and then I have to pay over these taxes. I have to pay. It's €2.50. They say, well, you have to pay 10,000 euros taxes. What is €2.50? The point is, and the Court of Justice in this Hessen-Rundfunk decision took a very, I would say, very wishy-washy Pharisaic approach, saying no, but you could sort of you should pay without further payment fees, but with a series, and it's up to the member states to decide whether you should do this or not. So just to point out that this this element of payments from the private sector to the public sector is something that I think should be considered within the payment possible reform of the PSD2. Having said this, I'm sorry if I've been rather disorderly and just put a whole unloaded on this table a whole series of questions, but I trust that last few speakers will put a little bit more order in my disorder. Thank you. I'm changing my hat. I'm supposed to chair this session, and so I'm very glad to give the floor to Professor Cheredinchenko from the University of Groningen, who's going to speak on the public-private divide in EU financial regulation. Professor has some slides, so she can
Oh yeah, let me start once again.
no, for the
yeah, thanks a lot to the organizers for inviting me to speak at this important and very topical event. What I will do in my talk is to discuss the role of the public-private divide in EU financial regulation, and in so doing I will also try to set the scene for our further discussion today. So, but before we go, of course, into the peculiarities of the public-private divide in EU financial regulation, let me briefly revisit the role of the distinction between public and private law in national legal systems, as this distinction has evolved in the national context. So, I think many things that you will see on this slide should be very familiar to you, but still it is useful sometimes to revisit this distinction in order to understand what is going on also in the field of financial regulation. So, in national legal systems, public law has been traditionally associated with the law governing the relationships between private parties and public authorities, in the pursuit, obviously, of the public interest. And the kind of justice that underpins national private legal orders is distributive or social justice, which is concerned with socially just distribution of goods in a society via tax law, for example. And public law has been typically enforced by public law means, in particular by public authorities using fines and other administrative law, particular administrative law tools for this purpose, in order to ensure ex ante compliance and deterrence. So far so good, but if we just compare this with the traditional image of private law has been governing the relations between private individuals and provide them with a framework within which they could pursue their private interests. Well, private law is concerned with interpersonal justice, which is particularly about the balance of interests between private parties. And if one party has suffered damages, the other party is under the principles of corrective or interpersonal justice is supposed to to compensate them. In terms of enforcement, private law also typically works quite differently from public law. And in private law, if we have a problem, if we think that we are wronged by another private party, we will normally go to a private law court, and we will take the initiative to this action ourselves, seeking ex post compensation. That is, compensation after the problem has already manifested itself, after the damage has already been suffered. Well, this is a traditional picture, and which has provoked also much criticism, even in national legal systems. Many scholars have challenged, of course, the public-private divide, but I will not go into that in the context of EU, in the context of national private law, and because I think that it is still fair to say that the public-private divide is still relevant in national legal systems, particularly when we consider how the law functions today, how the legal profession is organized, and we could also argue that public law is still primarily concerned with the vertical relationship between public authorities and citizens, whereas private law provides a horizontal legal framework that allows individuals to pursue their own interests as self-determining agents. So this is the traditional framework that should be familiar, I think, to many of us. And let us now take a look at what is happening when EU financial regulation becomes central, and how EU financial regulation actually influences this public-private divide. Can we speak about the public-private divide in EU financial regulation? Or is it blurring the lines between public and private law? And indeed, when we look at the regulatory landscape, when it comes to financial services more generally, and payment services in particular, which is of course the focus of our conference today, we see indeed that the well-established categories of public and private law that we've known from our own national legal systems, they indeed become blurred. So the logic of EU financial regulation, and this applies also to PSD2, is very different. And financial regulation and EU private law, which is in fact a type of market regulation in my view, it is not concerned with justice between individuals. It is not concerned with solely with private enforcement of private law. The logic of EU financial regulation is concerned with the three principal issues. Firstly, what is the goal or outcome to be achieved? What standard of conduct, secondly, is required from market participants? And thirdly, what enforcement techniques are appropriate to ensure compliance? These three questions underpin the EU financial regulatory landscape, which is, of course, very pragmatic in a way, and which is concerned with problem solving. So if we just revisit these questions in the context of payment services, in particular in the context of the existing harmonization measure in this area, which is PSD2, we can say that when it comes to determining the goal to be achieved, PSD aims to come up with a single payments market, particularly in the context of the EU's digital strategy. PSD is very much concerned with fostering innovation, technical innovation in the area of payment services, and opening up competition in this market. And well, consumer protection can also be seen as a separate regulatory role in this regulatory objective in this context, but it is not the primary objective of PSD2. It is one of the objectives which is in a way subordinate to other goals, particularly the creation of a single payments market, fostering innovation and competition in the payments market. And when it comes to the second question, how to regulate once those goals have been set, PSD2 combines various public and private law tools in order to achieve those objectives that I have just mentioned. So we see here a mixture of public and private law instruments, and on the more public law side, we could mention, for instance, authorization requirements for payment service providers, because you are only allowed to provide payment services if you are authorized as a payment institution, which goes, of course, back to the administrative law setting, and which is indeed very important today. If we consider, for instance, another important tool which has been used to open up the market, particularly for payment services, we could mention the obligation of banks to allow access to other non-banking institutions, particularly fintech institutions, to their client databases and to their systems, which is, again, well, a very important tool to open up those markets. And what is interesting also, of course, to mention is that PSD2 is very much concerned with liabilities. And the liabilities for losses, of course, they go to the heart of payments law. And PSD2 has introduced a very extensive regime in this area, which contains, for example, a basic rule that in the case of unauthorized payment transactions, losses are generally borne by payment service providers as more stronger parties, unless the user of payment services has acted fraudulently or with gross negligence. And this rule is, of course, it is designed to balance the interests of private parties in line with what we are familiar with in the context of traditional private law, national private law. But in the EU context, these rules, they also have regulatory objectives, because this division of responsibilities between payment service users and payment service providers is designed to provide the right incentives for both parties to ensure the safety of payment systems. So from payment service providers, it is expected that they, as stronger parties, invest, of course, in the safety of their payment systems. But the user is also not entirely immune from the responsibility. So we should not keep our credentials together with our credit card, for example, because this would be considered gross negligence, probably. So in the case of fraud with our credit card, we would have a problem. This provides an incentive for us to keep it safe. But the idea is, of course, it's in the context of financial regulation, it's not so much this justice between providers and users, but it is about the right incentives so that each actor contributes to the creation of the safe payment system, and thus the EU single market in payments. Particularly now we have this interesting, I think, discussion in the context of the revision of the PSD2, whether the standard of care that is expected from consumers should be the same, or it should also take into account specific vulnerabilities of certain types of consumers, such as elderly people who may generally be less familiar, of course, with technical aspects of payment services. And the question is whether the standard of consumer protection, the standard of care, should be adjusted. But okay, this again, the, this discussion, it is concerned with the balance of interests between the parties, but the overarching regulatory goals, of course, dominate this discussion, which makes this area very different from the traditional private law thinking. And when it comes to enforcement, the third important aspect that we need to mention here, EU financial regulation combines different enforcement mechanisms. So it is, although financial regulation heavily influences horizontal relations between private parties, and in particular payment services directive could be considered to be an instance of EU private law because it affects the horizontal relations between private parties. Yet we can see that the EU is experimenting with various enforcement techniques in this area. In particular, public enforcement through administrative law means in the area of prudential regulation, but also in the area of conduct of business regulation is very present. But also private enforcement, all these liability provisions in the directive. So they actually enable the aggrieved individuals to claim compensation for damage. And individual and collective enforcement should also be mentioned in this context. The EU has, in general, I think it is important to say that the EU legislator has focused on promoting public enforcement in the area of financial services, but also in the area of EU private law more generally. And so I think public enforcement has been really the focus, this agentification, I think what Michelle will be talking about. This is very true for payment services, for financial regulation, for EU private law more generally. But apart from that, we also have some role for the EU in promoting ADR when it comes to individual enforcement, but also collective enforcement. We have now the Representative Actions Directive, which also applies to payment services. And finally, in the area of financial services, we also have what I would call hybrid enforcement. And this is basically when a regulatory agency becomes involved in the provision of compensation to the aggrieved consumers. And particularly the UK's Financial Conduct Authority has had quite far-reaching powers to this effect, with the possibility to set up a redress scheme and in a way to force the firm that has violated certain regulations to compensate consumers. So we see here that you have a public regulatory agency on the one hand that seeks to ensure compensation, in particular private damages, to the aggrieved private individuals on the other hand, which is a kind of hybrid. So I think this discussion shows that the logic of payment services regulation and financial regulation more generally differs substantively from that of the national private law landscape. So what we see here, and I think this is true not only again for payment services, but for EU law, EU private law more generally, we see this functional approach to lawmaking. The EU legislator's task in the context of market integration is viewed as problem solving. The distinction between public and private law as such is not recognized, and public and private law concepts are used as regulatory tools in novel combinations. The EU is, in other words, experimenting with them. And I think the Payment Services Directive, the PSD2, is a very striking example of that experimentation. And where does all this experimentation actually lead to? It leads, in my view, to the emergence of legal hybrids. So we are not talking here about more or less pure categories of public and private law, but we are talking about the hybrid legal fields which combine elements of public and private law. And Hans Niklitz, for example, has come up with this term European regulatory private law in this context, which combines regulation with private law, two things, two oxymorons in a way that were traditionally considered to be incompatible with each other, but now they come together. I have also come up with this European supervision private law to show how private law becomes a tool and becomes integrated in the supervisory framework for regulatory agencies, particularly for financial regulators such as the Bank of Italy and other financial regulators in this area. So the hybridization of, um, of, of, of the law is the result. And this leads to a very complex legal matrix that governs payment services in particular today, but also more or less, financial services more generally these days. And you can see here that when we talk about payment services, we are talking about not only national private law, but basically we're talking about national public law, which for some private lawyers is still a very difficult thing to acknowledge, because we want to protect, something, some at least, they want to protect, the traditional field, whereas public law is really intervening. It is becoming more and more influential, and I think it has become for many years, and the role is only growing, particularly in this digital landscape. And I think that all of this is true, and it will become perhaps even more complicated if PSD3 is adopted. We are not there yet, but it seems that indeed the study evaluating the performance of the current regime seem to point in the direction of the new regime. But this legal matrix and this logic of EU financial regulation will remain unchanged. And I think it is very important to better understand it in order to be able to make rules in this very complex area. Because what we also see that once both national public and private laws are becoming involved, we see that payment services and are not only about disputes between providers and users being brought to civil courts. We also see, of course, administrative agencies being involved here, administrative courts, obviously, and this makes the matrix very complicated. Because we also have, of course, on the more private side, we also have private regulation here and standardization and ADR dispute resolution. So this brings me to the question about the role of this public-private divide. So does it mean that it is totally irrelevant, that it has become totally superfluous in the area of financial regulation, or is it something that still relevant when it comes to the way we think and the legislators and courts see the area of payment services and the area of financial services more generally? And let me just compare in order to better understand this. The two directives that have been adopted in almost the same time, I think it was after the adoption of the Lisbon Treaty, that the Payment Services Directive as well as the Markets and Financial Instruments Directive were adopted. And what is interesting to see here is that there is a striking difference between these two measures, both of which essentially govern the provision of payment services or investment services to private individuals. So we have in both measures an extensive what I would call public law component consisting of authorization requirements and operating conditions for the providers of the respective services. But there is also a remarkable difference when it comes to the liabilities, when it comes to the rights, to the individual rights and liabilities under those measures. Whereas in PSD2, we see that it has managed to achieve a quite extensive harmonization of the private law component, of the payment services providers and users' mutual rights and obligations, and even, for instance, it is concerned with, it contains detailed liability rules allocating losses between all those parties involved, and even, which is quite interesting, for the EU lawmaking, particularly if we recall the principle of procedural autonomy of the member states, we see that in PSD2, the rules improving the procedural position of consumers with respect to the burden of proof, for example, have been included. So it has been a quite substantial, I think, incursion into national private law systems. It is an illustration of the diminishing role of the principle of the procedural autonomy in EU lawmaking. Whereas if we compare all this with what we see in the Markets in Financial Instruments Directive, we just don't see that private law component. What we actually see is that we see an extensive harmonization of particularly supervisory powers and administrative law tools, but we don't see individual investor rights and private law remedies. The principle of civil liability has ultimately not been included following the opposition from some member states, as well as the financial industry. And the difference, I think, in harmonizing effects between the PSD2 and the MiFID II is quite striking. So we have, on the one hand, quite far-reaching harmonization of private rights remedies in the area of payment services, but we don't have something like that in the area of investment services. And you may wonder why. Well, there is no, I think this is not a result of any systematic analysis of the merits of what I would call the public or private law grammar. It is not the result of that. It is basically the result, I think, of the overall regulatory bias of the integration, EU integration paradigm, but also of, I think, path dependence, which the pre-existence of a certain regime before, for instance, we had harmonization earlier in PSD of private law in the area of payment services, but we didn't have it in the area of investment services. This could be one explanation, but obviously the political constraints of the EU lawmaking, such as lobbying, which have been very influential and which can explain also this kind of disbalance. We don't have a reasonable explanation why PSD2 includes the private law harmonization, whereas MiFID II does not. And you may wonder, what does it matter? It matters a lot also in practice, because if we look at the case law of the Court of Justice of the EU in the context of payment services, we see that it is quite proactive. For instance, it interpreted the liability regime in the case of unauthorized use of payment services as basically superseding the national liability regimes, which points to a very limited role for national private laws in the area harmonized by payment services, the Payment Services Directive too. Whereas in the area of investment services, we see that the court did not really seize the opportunity to clarify the relationship between the conduct of business rules in that EU measure and national private law remedies, leaving it basically to national private laws. And we've done much research on that, and we see that the results at the member state level are quite different. The extent of the influence of EU investor protection regulation, notably the MiFID II directive, varies across different jurisdictions. So yes, it does matter. And what we see indeed that in the context of the revision of the PSD2, we are having this debate now on whether or not to include, to provide um, a different standard of care when it comes to elderly people, whereas we don't have anything like that in the context of investment services. Whereas, of course, vulnerabilities, I think, they don't only affect investment services or payment services. So let me just conclude by basically, I think, just 2 points. I think it is clear that EU financial regulation has blurred the public-private divide quite significantly. We see indeed that the logic of payment service regulation is very different from that of national private law that has traditionally governed payment services. We've seen the rise of legal hybrids, and I think the PSD2 would be one example of that. But in my view, the conceptual distinction between the categories of public and private law has not entirely lost its significance in EU and national law today. And as hopefully my analysis has shown, it could be useful to analyze the interplay between EU and national law in regulatory standard setting and enforcement, just to better understand it, without, of course, any attempt to draw a strict line between public and private law in the context of EU financial regulation. That would obviously not be a good idea to start with. So I think you could see it as a kind of hybrid car, the area of payment services, which combines this combustion engine and an electric motor. And in order to understand how it works, it's important to understand the individual components of what make it a hybrid thing. So you could perhaps, we could apply this logic also when trying to grasp a very complex and an increasingly more complex and costly regime for payment services. Thanks so much for your attention.
Thank you to Professor Sheleznychenko. Well, this last slide brings us to the doubt whether we're going to sort of go towards sort of totally electric and cars, or we're going to have return to internal combustion cars. But anyhow, apart from this frivolous comment, I'm very happy to give the floor to Professor Benjamin Geber from Oswald Hall University, and very glad to have him here in Rome. Professor Geber, the floor is yours.
Yes, thank you very much. It has been my pleasure to speak here, and I want to thank, of course, primarily Professor Bagiti for inviting me. And well, I hope that, and I'll try to fit everything into the 20 minutes that have been allotted to me. So one thing is that one big change that we have now with the PSD, we shall have with the PSD3, is a new, and it is basically, it's not so much question of new payment systems, but rather a new payment object. Okay, because until now we're kind of thinking about cash vis-a-vis a balance in bank account, and the PSD3, of course, dealt more with the balance in bank account. But of course, now with the appearance of digital currency, there is now a more monetary object, which has now somehow to be fit in. And what I will try in this, again, in these 20 minutes allotted to me, is simply to set it into a broader context of the evolution of money and payment system, and give you some material for thought. So for one thing, I like this broad definition of money, is which is in English case, that which passes freely throughout the community in the final discharge of debt, being accepted equally without reference to the character or credit of the person who offers it and without the intention of the person who receives it to consume it. In other words, you are not going to eat money that you get. And the idea is that we have this joke: from you I will accept, from you I will accept even cash, which essentially means that we don't care. You may be the worst crook in the world, but the cash itself, of course, there is the issue of counterfeit money, but let's leave this aside. So, in general, if I'll put the evolution of money as opposed to evolution of payment services, money is being the means of payment. So originally, historically, when I go, of course, very quickly, there were bartered goods. Then what I call primitive money is when certain goods have become to be used as equivalent to money, like sheep, like bracelets, etc. Then it kind of move on to weighted and standardized pieces of metal, gold. Then the pieces of metal has been solidified into coins. You didn't have to weigh them. They had the value given by the prince or whatever, the government. Then there is the banknote, which is, of course, this is the one that we are familiar today, started as a promise of a banker to pay the coins and then ended up being on its own. And then we do have, as opposed to this object, we have monetary value on a ledger, which is we call bank money, which is a balance on a bank account. And the e-money, it is when this balance in a bank account is actually moved from the bank account to a device. But that's like the debit card, basically, not the debit, the smart card. Sorry, that the value is on the card itself. Okay, that's not all smart cards, but some of them. And then we move, of course, to the digital currency. So I will not have time now to go over this complicated chart, but what I try to do here, if you can look at it in general, from top to bottom, is that originally we have the chattels, chattels, the primitive money, the metallic money, then we put the metallic money in the bank, and this is the bank deposit. From the bank deposit, then people, well, this is the check, the debit transfer, the credit transfer, and the check has developed into the credit card, debit card. The metallic money has developed to the banknote, which is then led to the promissory note. The metallic money was also led to the payment in metallic money has been switched to payment by bills of exchange. What you find within this square is basically what is governed by the law of negotiable instrument, but again, this is just a side point. And then from the banknote, we do have the paper money. So this is kind of, as I say, I could spend 20 minutes just explaining this chart, but it gives you some idea how it all had been evolutionary and not just kind of one thing burst into the other. And I don't have here the digital money yet. This was prepared from before, but essentially it would be the kind of the electronic means which are now used instead, well, something electronic instead of the paper money. So if we have today the domestic payment system is that we have customers who have accounts. I use the Canadian terminology, but there are small institutions, there are big institutions. The big institution has their account with the central bank. So we have all this network of money that moves. But of course, we do see that there is this money in the central bank is the amount is smaller than all the money which is in the heads of customers. And this is where we have the distinction between commercial bank money, where customers have with commercial banks, and then what banks have with the central bank is obligation of the central bank. And then when money is, of course, put into the bank account, then it is ceases altogether to be the money of the depositor. It is then money of the banker, and that's very important in the concept of banking. We do talk about our money with the bank, but it's not our money. What the bank owes us money. The money is the money. It's not. The money is actually belong to the bank. The bank lends it in its own risk, and this is where we do have this is banking. What banking has been all about, this financial intermediation. So we do have the saving depositors put the money in a bank, and then the bank uses the same money to give money to borrower. So there is some magic that actually creates more money than originally existed. This is in a nutshell, and that's very important because, of course, then there is a risk that our commercial bank will not pay the money, okay, because it already used it to give it to the borrowers. Okay, so of course the whole business of banking is based on making sure that there's not going to be mismatching between reasonable demand and and then we do have all these protections of regulation and deposit insurance, but fundamentally it will be just a matter of private law. If I'll use what happened, what was discussed earlier, it is the money is not there in the basement, so to speak, waiting for us to pick it. And that is what we do have. We see central bank money is a small amount. I mean, this is not in scale relatively to the commercial bank money, which is in the hands of the public. But then there is one item of central bank money which is in the hands of the public, and this is the bank note. Okay, so the difference is that when you have a bank note, you have direct obligation of the central bank in your pocket. When you have money in a bank account, you have the obligation of the bank to give you this pieces of paper, which is the bank notes with obligation of the central bank. But that is, of course, makes the legal risk different because the central bank will never go under. I mean, the value of the money that the central bank gives you may be nothing if there is high inflation, but a dollar or a euro will always be a euro, no matter the nominal value will always remain 1 euro, no matter what happens in the economy. So this obligation you do have with the central bank. You, commercial bank, you have the obligation to give you this piece of paper, but it's not as strong as the piece of paper itself. And there, this has created all sorts of ideas, and one of them is what is called, which is basically allow people to have direct account with the central bank. I don't call it digital currency because I think that it confuses two things, and I'll get to it. But essentially, this is one option that actually all of us would have account with the central bank. Why should we even give the banks the power to create the money by using it and lending it? Another, sorry, I'm in the wrong direction. Another possibility, which is not different, is that no, we should have our money in the banks the way that it's now, but the banks will have full reserve to back it. In other words, today we say we have fractional reserve because, as I'm saying, they're using much of the money that we deposit to lend. So we'll not allow it to happen. We have to have 100% reserve. So again, these solutions would, well, they have their own problem, but these are kind of solutions that people do speak about it, and actually they speak about it long before the digital revolution, just to put things in context. It's nothing, the two things that I now just described have been proposed long ago. But what we do here now is actually, and I'll go back immediately, is a digital coin, and that is the difference. This is a different concept. So before, just what is bank account? What is bank note? Again, as a matter of form, is an unconditional promise in writing signed by a banker who commits to pay a certain sum on demand to the bearer, being the holder in possession, and then we basically, it's transferable from one person to another, so it has to be signed well, so then the question is whether we can create something equivalent, which would be signed electronically. Possession would be the control on this thing which is signed electronically, and delivery would be transfer of control. And once we have that, then we have some kind of, well, not some kind, but we have e-banknote basically, which is a digital currency. And what is a digital currency? The true digital coin, as opposed to the arrangement that I described earlier, is an entity that amounts to a string of bits. The string must have a numerical value, and in order to prevent otherwise, then it has to have unique identity, exactly like a banknote, except that it's not going to be in your pocket, it's going to be on your device. Well, I left my device there, otherwise I would have shown it, but you will know how my device looks. And the idea is that you will be able to make payment not through the bank account. You may buy it from the bank account, but like you buy today the banknotes when you go to the ATM. But fundamentally, you will pay directly from one person to another through, well, whatever would be the way that will happen. And this is a true digital currency. But now this is where we start to having important distinction. When it can, this banknote, exactly like this digital coin, exactly like the original banknote, historically now, is issued only privately. Okay, but again, banknotes were also issued originally privately. And the question is whether it will be taken over by central banks, the way the central bank took the issue of the banknotes, and this is the CBDC, central bank digital currency. And the question is whether they will live together, the digital currency and the virtual currency. Okay, the virtual currency being the one that is issued privately. And then again, when we talk about, I'll not read this one, the virtual currency, or in general, could be either self-anchored. This is the Bitcoin that basically has its own value the way that the market bears. It doesn't have a specific unit of account which is referred to some kind of an asset. But alternatively, we could have a claim check, and this is a stable coin, which will have this digital entity, which is the value $1 or €1, and this would be exactly like the banknote. But again, the question is whether it will be issued privately or when it isn't issued by the central bank. So it asks me what is the difference. The difference is, and I'll skip this one just because I don't want to. Yeah, no, I'll better skip it. Yeah, so the idea of the stable coin, that it is digital currency denominated and pegged to claim at par with the official currency. But again, it is the point is that it's very much like the original banknote. It's still the promise of the private issuer. And if you think that the promise of the private issuer is of course, it's as good as the private issuer. But again, the solution is that there should be 100% reserve against the thing, and this is where you require, or which is required, to have some form of strict regulation. And even then, there will be all sorts of risks, because if there is a pressure on, there's going to be some attack on some, so to speak, an issuer of this virtual coin, so to speak, and will not be able to get all the backing for all of them, which is exactly happens when we do have foreign, well, some countries have what is called currency board, which essentially their issue of currency is backed by 100% of some strong foreign currency. But then, when there is a big attack, then very often they cannot get, for their own liquidity, they cannot get enough of the foreign currency. And of course, it opens, that's a classic Argentina story. And then you do have all this issue that, of course, there is always a temptation to cheat a little bit the regulator and not to have 100% reserve, even though by law you are required. And then there is this, and then so people do say that even if we have a system of virtual currencies which are all in the value of euro, and there is competition, which is very nice, but at the end of the day, there is issue of interoperability and risks. Also, if a bank have all the value of the dollars or the euros, again, I'm sorry, which backing its issue of virtual currency, what happens if this bank goes under, and the bank where the money is held goes under, and then all the reserve falls. So you would say we would have to have the reserve in the central bank, but again, all this creates all sorts of regulatory issues, which begs the question why we shouldn't have the central bank issues the digital currency, exactly like eventually we go to the conclusion that the central bank would issue the banknotes. And again, there's been a history here. of how the process started. And I think that here we are simply in position to shorten this process. And this is why I think that digital currency is central bank digital currency is pretty much the right solution. But of course, counter argument would be nothing that is completely free of problems. Is that, well, in the virtual currency world, there is a competition about innovation. But yeah, with the central bank, once they will have to have some kind of system which will still will allow for some kind of competition in maybe giving benefits the way the credit card giving benefits. I'm not entirely sure, but there has to be some way still to encourage some kind of innovation, technological innovation. This is what I suspect. But overall, it's going to be a better system than the one which is consists of a variety of virtual currencies which compete with each other, complement each other, but at the end of the day, does not create a system of uniformity of currency, which is not just uniformity of the unit of account, but also uniformity of the means of device, exactly like, well, when you have the euro, different country even, not just one country, it does have this kind of uniformity of means of payment. So, of course, as I'm saying, PSD3 is just a way to put it into context. We'll have to take all this into account, and because PSD2 is based on the fact of payment through account balances. And now we have this new device, and it has to, so to speak, not device, new object, and this, of course, has now to be somehow, it's a very important variation, which will require some kind of both regulation and, well, safety devices and all these things, which I'm sure that the drafters of PSD3 will not, so to speak, will not miss. Thank you very much for
Thank you, Professor Geva, and for this optimistic conclusion. Well, I'm not so optimistic as yourself on the sort of the view of. Yes, okay, yes, no doubt about that. But sort of somehow one looks at the certain experiences and one has a doubt that in Brussels they really see what's going on. Anyhow, I'm very happy to give the floor to Professor Michelle Everson of Berkeley University. The floor is yours, Professor Everson.
Just bear with me a moment as I into a presentation. There's the presentation. Right. First, my apologies. Well, I was going to say I don't know that much about payments, but as the previous speakers have spoken, I've suddenly realised how much I know about payment systems and how excited I am by this conference. So thank you very much for inviting me. I have a more generalist paper together with my partner in crime, Ellen Boss. We've been working about European agencies, regulatory agencies, for a very long time now. And I will be speaking to the role exactly as being pointed out, the rather troublesome role of European agencies in the regulation of financial industries, payment systems in general, exactly at that point, and thank you very much for the terminology, where we have a hybrid situation developing between public and private law. I'm trying to think, what is the problem in a nutshell? The problem in a nutshell is that this stuff matters. It matters deeply. I think we've just heard in the final presentation what the actual stakes are. We are talking about Karl Polanyi, great sociologist, always claimed that money doesn't exist. Money does not exist. There is no such thing as money. Not in a Marxist sense, just in the sense, think about money and think about what we've just heard. Money is what we want it to be. And the basic question at the moment is, are we happy with the chaos of the crypto system, the competing private forms of money, or for public reasons, for reasons of public safety, for reasons of this, that, and the other, do we want to contain that money within a legal framework which gives it the particular character that we want it to have? We also had the notion about the systems payment directive, its purposes, innovation, a private market concept, innovation. We want the magic of money. We want this wondrous way that money begets money in the banking system, even more miraculously in the insurance system, where loss begets money. How does that work? We want that glorious innovation, but at the same time, we want control. We want sovereignty. I think a lot of the prudential regulation, banking union of the past years, has to do with re-establishing the sovereignty of our public authorities over private money making, over credit, ending exactly this dichotomy between the banknote, which is a sovereign instrument because we can determine what the concept of the banknote is, yeah, and the credit industry, banking industry, the new forms of banking that have been digitalized and creditized, and algorithms, what have you. So a lot of prudential regulation is about that. So this stuff matters. It's also horrifically complex. It matters to us as citizens. It matters so much to the peasant on the hill in Tuscany who can't pay, can't pay because they can't get the Wi-Fi. It matters. It really matters, but it's so complex, and how do you explain that? Now, Jürgen Habermas has surprised me. I didn't expect to be surprised by Jürgen Habermas. He's recently put out a little book, tiny little book, in which he puts his whole theory of legitimation, deliberation, in doubt. His life's work he puts in doubt because, he says, the world is so complex that we need the technocratic problem solving, the European technocratic problem solving, but this is also complex and so distanced from the individual, that we have a real danger of a lack of faith and a lack of trust. We need somehow these three forms of knowledge, Lisa Herzog, three forms of knowledge: innovation, in the Hayekian sense, discovery, in the Hayekian sense, the private market, the miracle of money begetting money. We need that. That's the way our societies are built. The command model, we're just not up to producing a command model that works. So we need that innovation. We need the technocratic, the epistemic. We need that. We need that knowledge because this is so complex. How to combat systemic risk. That's one of the all-time favorites, isn't it? We need that knowledge, but at the same time, we've got to have the simplicity and the deliberation, because it's got to be clear to people on the streets, people out there who are, I have to use a digital wallet because I can't get my credit cards over the border from Germany to from the UK to Germany. So I've become vulnerable thanks to Brexit. So I have to use a digital wallet, and it has somehow to be clear to me when things go wrong, or what have you, what is going on. Yeah? So it's important. Now, within Europe, as I say, I'm now slide hopping because I've gone. How does this work? So I can't find the arrows. Aha, or they click. Sorry, young person. Digital mastery. Oh, are those the arrows? Yeah. Not the arrow. That's the arrow. Right. I'm slide hopping now because I've sort of left everything behind, the general discussion. But within Europe, as we say, we have had agencies, regulatory agencies, and the central bank have become the hybrid institutions that govern, that look after us in these areas. They are the post-national embedding, I think. This is the way to look at it. If you think about Karl Polanyi's thesis of embedding of the economy in a national setting, the idea money doesn't exist, land doesn't exist, labour doesn't exist, we embed those vital components of the political economy through our regulation and through our lawmaking. Now, we know at the national level how that works. We know that it's a parliamentary system, it's a what have you, it's a democratic constitutional process. Into the post-national setting, what is happening? What has happened at the post-national level? Now, I'm going to be positive as well. I will say that the agencies are a re-embedding process, but this has been a difficult learning process and it leaves many questions open. Agencies within the European Union are a part of an evolving polity. They came to fruition within Europe simply as a result of crisis. Simply as a result of crisis. We had regulatory problems that arose out of nowhere. The first real impetus for agency creation is the BSE crisis, which led to the development of the European Food Standards Authority. Okay, so that's the first real major impetus. The financial crisis was the second major impetus, and we had the development of the banking agency, the insurance agency, what have you. At the time, we developed autonomous regulatory agencies in order, as we say, to combat systemic risk, to make up for regulatory failings. So it's a reactive policy. There's no provision for European agencies in the treaties. There was no conception, as we all famously know, of the EU ever having a regulatory competence, let alone a regulatory competence that is exercised within autonomous structures outside the classic structures of the European Commission and what have you. They are famously, initially, you ask ourselves, what's legitimate then about this? What's legitimate about this sudden burst of executive activity outside the structures of the treaty? Famously, Gian Domenico Maioni, the godfather of European agencies, gives them a legitimacy that is related exactly to market-friendly thinking. These are Pareto-efficient organizations. They deal only in areas of non-distribution, pure market thinking. Therefore, they are legitimate. They are purely technical. That's all they are, so you don't have to worry about their constitutional legitimation. Obviously, that's simply not true. It's simply not true. It's not true within an evolving European polity. I'll slip over this because it's a bit, you know, because agencies are used to do so many different things at different levels. They are used in terms of the public-private divide. They are used by the member states. They are part of general networks of regulation, even at international level. So we have a doubt about the legitimacy of agencies at a sort of purely conceptual level within the treaties. But more importantly for our purposes, we have the case of ESMA, the European Markets Authority, roundabout MiFID and what have you. Exactly this idea of, well, you know, are they really purely technical decision-making bodies legitimated purely within a market paradigm? What is this about the experts? Think about it from your classic constitutional paradigm. You're going to be hugely concerned about the privileging of expert knowledge above democratic knowledge, the privileging of sectarian knowledge above democratic knowledge. Yeah, you are going to be concerned. It's part of the liberal paradigm. So We also have, in those terms, in the European Union, we have the Moroni Doctrine, which says that's fine, agency action is fine because it is within set limits of delegation to answer those constitutional concerns. What can I say? It's simply not true. It's simply not true. We've already heard just how important the definition of money is. The prudential regulatory schemes that are developed are obviously very much a part of our definition of what is sovereign money, where the control lies, what we want money to do, what we want money to be a part of in our society. So what can we say? We have the court brushes over the issue. It says, look, ESMA is somehow working within delegated powers. Rubbish, absolute rubbish. But there we are. We live with that. We live with these. What do we live with? We live with, well, it's not exclusive to the European Union. It's all legal systems. We live with these areas of uncertain knowledge. What has been concerning, though, I think, about the European agencies in particular, has been the degree of political application. A lot of these problems are political problems, especially around financial crisis and around systemic risk. We know since the pandemic that actually there is a lot more public money, there is a lot more investment opportunities, there is a lot more room to act in a classic command manner. However, with the transfer of competencies for the control of money, the prudential regulatory systems to the central banks, we see an ongoing denial of that fact. We see an ongoing issue. I think it's what you're talking about. It's exactly what you're talking about. It's that reformulation of money, but an uncertainty at the level of the political system, or an unwillingness at the level of the political system to actually deal with those issues. This is I'm just checking the time, this is to a large degree a real problem for the agencies and presumably also for the central bank, because when you get the political abdication and the problems being passed over to agencies, you see it very particular in terms of Frontex, that there is no agreement on migration. So you pass it as a technical problem to the Frontex agency. Yeah? You see that sort of, we don't want to deal politically with these issues, so we will pass the definition of what is a systemic risk, how do we design money, what degree of protection is there for the public. We pass it over to the regulatory agencies, the central bank. There is a danger. There is a danger. We can be positive about it. I mean, the degree to which the regulatory structures within Europe, and this is why I would say we are seeing a re-embedding of regulatory structures in the post-national environment, the degree to which they've actually mastered crisis has been extraordinary. The systemic risk concept has worked. The banks have intervened, and we didn't see a collapse of the currency. Unberufen toi toi toi. Hopefully we won't see a collapse of the currency in relation to inflation as a systemic risk, in relation to cryptocurrency as a systemic risk. And all of that is obviously, it's the technical knowledge of the bankers. They themselves, the banking regulators, the financial regulators, they themselves are developing their knowledge as time goes by, and they seem to be quite good. So there is that technical knowledge in the system. However, there is always the danger. What happens when they do fail? What happens if they do fail? If their one legitimation, a degree of legitimation, is doing the job properly, what happens when they fail? The reputational risk is always there in the background. So that is, I think, a problem for us. The solutions, I come back to the point that this is a problem we have to solve. We have the hybrid institutions that are dealing with different logics. There is a lack of political will. However, the stakes for us are so great that the solutions have to be found. Giandomenico Maioni himself has stepped back from his market positions very much into a paradigm where he says, look, beware, there are endogenous limits to agentification, to technocratic knowledge. The endogenous limit is that science runs out, that expertise runs out. There are doubts about whether there is such a thing as Pareto efficient regulation at all. All risk distribution is surely a redistributive issue. So you have to be aware of that. You also have to be aware of the exogenous limits to technocratic organization. Issues that are simply political, that are being transferred to agency bodies, as I've said, because it is convenient to the political system, especially in a mixed polity like the European Union, where you're not going to get political agreement, to rephrase these issues as technical issues and pass them on to the agencies. Maioni says, no, this, my model collapses. It's like Habermas, my model collapses. We've got to sort that. So he talks about in terms of being much more explicit about a Europe of clubs, making clear those groups who are prepared to take political steps and to mandate the executive arm within a clear political program. And I think that would include digital currency, the central bank taking control of digital currency, something like that, which is a clear way forward. So that will be a Maioni approach. I've already said, look, the agencies at European level are surprising. This is the process of re-embedding of our false commodities, labour, land, capital, within a post-national environment. Brexit itself, I think, has demonstrated that quite clearly, is the degree to which the British economy, falling out of those structures, is suffering. And suddenly you realise, hang on a sec, standards, regulatory standards, non-tariff barriers to trade, all those technical terms that we might have been a bit dismissive of as being too market-oriented, slowly but surely it becomes apparent that those are actually processes of re-embedding, processes of re-establishing our values, those important values, within the market setting. Now, for me then, the point is exactly to find ways of institutionalizing and constitutionalizing those three knowledges, the market knowledge, the epistemic knowledge, and the deliberative knowledge, within a system that is simple enough for people to grasp and to understand why certain regulatory steps are being taken, and to understand why they don't get compensation in all cases of their digital wallet disappearing. Yeah. Now, that's very easy to say. I'll come back to you in about 10 years with an answer to that one. So I'll stop there today.
Thanks a lot to Professor Everson. I'm very happy for the speech because she brought me on a field in which I'm more familiar with than the one of financial markets. We are going to end this first session, the first session of the morning, with Professor Daniel Sarmiento of the Complutense of Madrid, level playing field in the multi-level governance of payment services. The floor is yours, Professor Sarmiento.
Thank you very much. Thank you very much, Chair. And speaking of chair, I'm going to be staying in my chair because I don't have a presentation for you. So allow me to try to stay here, but I'll try to be as clear as possible despite the lack of a presentation, of a PowerPoint presentation, I mean. First of all, thanks very much to Professors Brescia, Mora, and Paglietti for the invitation to be here. It's always a pleasure to be in Rome, and particularly in such distinguished company, and in this panel. And for the topic that's been assigned to me, the topic of level playing field. Because the level playing field is a rather abstract notion, but it's a key notion not only in financial services, but generally in EU law at this time. And my task here is to focus on the notion of the level playing field in the field of payment services in the context of the EU and EU law. And that particular context is going to take me into a series of topics that I'd like to address, which have considerable importance, not just from the perspective of payment systems and payment services, but also from a broader perspective as well, for the overall financial framework, but I would even add for the overall regime governing the internal market at the moment. Now, why is the level playing field such an important concept? Well, basically because it's a principle based on the notion of equality. And the notion of equality refers to equality among the member states of the EU. It's an equality among economic operators operating in a common market, in the same market. And it's also an issue of equality among consumers. And this is a particularly relevant principle in an internal market like the EU's internal market for a simple factual reason. The EU's internal market is being created by destroying a fragmented bundle of national markets. This is not a market that appears ex novo. It is a destructive project because it needs to destruct 27 national domestic markets and turn them into one. So it's a rather brutal regulatory project, and therefore it requires the imposition of obligations, of painful reforms, and overall the goal of attaining an genuine internal market has an element of destruction attached to it. Now, from a legal perspective, if we go into more civilized tone, this means the introduction of obligations, of legal obligations on market operators, obligations on member states, obligations on consumers, but also the creation of rights. Now, in the context of the payment systems, we have a variety of elements that are important from this perspective. We have an infrastructure. We have a payment infrastructure, which is essential. And we'll talk about essential facilities later on. We have different kinds of players. We have bank players. We have non-bank players. We have a variety of economic stakeholders operating in the market. And we have a variety of national regulators as well. And those national regulators interact with European level regulators as well. And of course, we can add an additional layer of international regulators. So there are a series of factors that make the insurance of a level playing field in the payment system quite a complex project. It's a destructive project in the sense that it needs to impose quite stringent obligations on many of these players. And at the same time, it needs to create a coherent and consistent and functional payment systems for the benefit of consumers and market operators. Now, because of the fact that we are operating in the creation of an internal market, having to override 27 national markets, we have a whole variety of challenges to ensure a level playing field. Regulatory fragmentation, market concentration, particularly in the banking sector, which is getting worse and worse, technological disparities, which are growing among market players, cross-border challenges, but we also have disparities in national supervision because we still have national supervisors and regulators, regulatory arbitrage, which is inevitable on the part of market players. So the challenges are quite considerable. I'm going to focus on three. I'm going to focus very briefly on regulatory fragmentation first. Then I'll point at the standards of equality that might be considered to be sufficient to ensure a level playing field from the regulatory perspective. And finally, I will refer to some of the antitrust and competition standards that appear in this field. Those are three challenges among the many that appear in order to ensure a level playing field in the payment systems. Regulatory fragmentation. That would be my first challenge to highlight. In the context of the EU, we have to take into account the fact that the EU is operating in the creation of an internal market, in the particular case of a workable payment system, with a series of tools which can vary but not vary too much. Basically, the regulatory tools that the EU has at its disposal are directives and regulations. And those are the main legislative instruments that the EU has to create and ensure a level playing field. This is an issue of fragmentation because, of course, the choice of legal instrument can reinforce certain fragmented markets by allowing national practices to be consolidated, while the use of a regulation overrides entirely national legal frameworks and introduce a common uniform framework. The choice of directive and regulations is an important element in how and to what extent a level playing field can be guaranteed in the market. The problem is that directives are becoming more like regulations and regulations are becoming more like directives. The fact that directives are becoming more like regulations is an old, well-known phenomenon, but the case of regulations turning more into directives is a bit more of a new phenomenon. And we are seeing it quite clearly in the banking sector, where the appearance of options, discretions, of regulations in which member states can openly decide how to go forward, it's quite of a novelty, but it's becoming quite of a standard practice. We can see it in GDPR as well, and we are starting to see it in many other fields of policy. So the choice between directives and regulations, which was kind of a clear-cut choice, is not as clear as it was in the past. Now, that's an issue of choice of instrument, but what about the fragmentation of the material rules applicable to payment systems? If we take a look at the array of legal instruments that the EU has introduced, it's quite scary, actually. Of course, we have the two standard directives that govern the system, but besides the two standard directives governing payment services, we have a variety of directives and regulations that are introducing a degree of complexity into this framework, which is quite astonishing. Let's just think about cybersecurity, for example, and the duties imposed on market operators, including those who may be considered to be payment institutions. Think about money laundering, anti-money laundering. What we have now, what's coming, even an EU authority on the field. Think about the digital finance strategy of the European Commission, and what has that entailed? Think about what the DMA, the DSA, the Data Act is going to indirectly impose on certain market operators, which are currently working in the payment services field. Think about digital identity and trust services, regulations on AI, which are going to have an indirect impact on the financial service sector as well. Needless to say, GDPR, e-privacy regulation, and digital content and services directive applicable to consumers. We have a very broad array of highly complex instruments, which in a fragmented way, with different material scopes of application and personal scopes of application, are imposing considerable duties on market players, including market players in the payment systems. Now, the problem of fragmentation in the material rules that apply is not just a problem of a heavy regulatory burden, which is a problem in itself. It's also a problem because in the EU system, each regulatory tool can have its own institutional arrangements. Think about, for example, the banking sector, which now in the field of prudential supervision has new institutional arrangements, where now the European Central Bank has become a prudential supervisor for significant credit institutions. That is new. It's a new institutional arrangement. Think about GDPR and the way in which now national authorities are having the main task, because we lack an EU authority centralizing such functions. The degree of federalization that the policymaker, the EU policymaker, chooses in each policy area entails that for a market player, the institutional arrangement changes radically. If we're speaking about cybersecurity, then we're speaking about prudential supervision, then we're speaking about data protection, and the role of the institutional players changes. Their duties change, the intensity of what they can do changes, and that is an element of fragmentation which doesn't make operations within the system easy at all. So that's my first point on regulatory fragmentation, which, as you can see, it has several angles. Equality. What is equality in the level playing field? And what is equality in a level playing field in the EU internal market? Well, first of all, equality and the level playing field is important in the payment systems market because we have some market players which have duties to give access, very relevant duties to give access, and others don't, particularly to data. Some have very burdensome compliance duties, others don't. Some are operating in domestic markets only, others are operating in cross-border markets or in cross-border situations, and therefore in an EU-wide market. So from the perspective of the level playing field, we need to know what is the standard of equality that justifies why the legislator, the EU legislator, is introducing such distinctions. You are in, you're out. You do this, you do not. And of course, this is an old and well-known story about equality in legislation, but in the case of the payment systems market, it has achieved a particularly acute relevance because of the onerousness of some of the duties imposed on some of the payment institutions. Now, if we go to the basics of EU law and see what is the standard of equality that's required from the EU legislator, I think that the most relevant precedent is the one set by the Court of Justice in the Arcelor case. The Arcelor case is a Grand Chamber decision, 2008, in which the court systematized its position about what is the standard of equality that the EU legislator can impose, and the standard that it can impose on market operators to say you're in and you're out. And Arcelor concerned the greenhouse gas emissions allowance scheme, and the fact that Arcelor, as a steel producer, was within the system, but aluminum and plastic producers were outside the system. And Arcelor complained about that distinction. Of course, this sounds very far away from payment systems, but the truth is that the standard set in the Arcelor case is the standard that the court is using still to date. So when it comes to challenging inclusions and inclusions in any other sector, any other policy area of EU law, is the Arcelor precedent that is still applying. And what did the court state in Arcelor? Well, nothing too revolutionary, because it codified its case law on equality, basically by stating that there are situations in which a discrimination can arise and therefore an illegality can arise if there are comparable situations. And in those comparable situations, one of the actors in the comparable situation is left in a situation which is detrimental. And that detrimental situation can be an economic detrimental situation. That is all fine as long as there is an objective justification. And when it comes to the objective justification, which is the key of the equality test, the court was very careful to state that indeed there might be comparable situations and differences which are prejudicial to one of the players, but as long as there is an objective justification on the part of the legislator which explains why that exclusion has taken place, then that is a sufficiently good argument to accept that there is no breach of equality. So it's a rather minimal test, because when we look at the Arcelor case and we see what was the actual result, the court considered that the distinction between those steel producers and the rest of the producers, although it was a distinction which was hardly justified because they were so similar, the court took into account the fact that it was a sector which had just been created. The scheme, the greenhouse emission scheme, was brand new. There was not much experience about how it worked. There was not much experience about how it would evolve. And the fact that in the course of time the legislature could amend the system was sufficient for the court to consider that that distinction at first, at that particular moment in time, could justify that difference of treatment. Why is this important? Well, it's important because the court, when it comes to ensuring a level playing field, it's making an evaluative assessment. It's looking at the policy area, it's looking at how sophisticated it is, how developed it is, and if it's still at a nascent point, it is willing to allow certain differences of treatment for now. And that's something that we can also see when we extrapolate the situation to the payment systems market. And when we look at how the court has interpreted PSD2 and issues of validity of PSD2, which has done already, we can see a very similar approach to the one in Arcelor. Here, there is an interesting element which I would like to raise, and I would like to raise it in the context of the judgments delivered in the American Express cases, which are two judgments of the Court of Justice in which the validity of PSD2 was reviewed, and although there were no issues about the compatibility of PSD2 with the principle of equality, which is a bit surprising because the British court did not make a reference to the principle of equality or of non-discrimination. The truth is that the analysis of the court was very similar to a discrimination analysis, to a discrimination test. The way in which the court interpreted PSD2, and in particular, the way in which it interpreted Article 35, which imposes those obligations of access, of access to data and therefore to open banking, was very telling of how the court operates in interpreting a framework that introduces distinctions. Because in fact, in the American Express case, the court first had to interpret Article 35, and then it had to decide whether Article 35 was invalid, because it was including and therefore excluding as well certain market players. What the court did was to introduce a rather broad interpretation of Article 35, and therefore to assume that Article 35 can have a broad interpretation, even though it is a provision that imposes obligations. But having once introduced a broad interpretation of Article 35, which is in line with what was said before about how the court is actually interpreting the payment system, the payment services directives in a rather aggressive way in comparison with other financial service directives. That allowed the court to come to the conclusion that when it comes to the excluded market players, there is no issue of validity. So is that combination of interpreting the directive, interpreting the framework in a broad way, and then reviewing the validity in a way that's in line with the Arcelor criterion, leaves a rather broad margin of discretion to the legislator, and at the same time takes into account the evaluative approach of the area of policy, and having made a broad interpretation of a directive, the court is quite happy in determining that there is no issue of validity by the fact of excluding certain market operators. And now, finally, the third and last point, I'll finish here. I want to make a quick reference to the essential facilities doctrine, which I think is important from the perspective of the level playing field. In the payment system market, the essential facilities issue is always present because payment infrastructures in themselves are essential facilities. Now, of course, payment infrastructures are one thing, and operators in the payment system, like payment institutions, they don't necessarily need to be themselves an essential facility or handling essential facilities. However, we are reaching a point of digitalization which is making some market players in the payment system to be very, very close, to be the holders of essential facilities in some context, or to be defined themselves as essential facilities. And we have a discussion there, which is interesting. My point here is that we are seeing an evolution. We are seeing an evolution in the concept of what an essential facility is and the implications that that has from the perspective of competition law. And very briefly, I'll just make a reference before I finish to the evolution that we are seeing now in the case law of the Court of Justice on what is an essential facility and what is an indispensable essential facility that cannot be refused to other market players. Because we are seeing an evolution, and it's an evolution that is that I think is quite relevant, particularly for the financial sector, where we are seeing situations in which precisely what the court has been ruling on is applied to. As you will know, the issues of essential facilities are the domain of Article 102 and situations of dominance and abuse. That is the traditional context. In EU law, it has been quite a long-standing case law that there can be market players which are dominant, to which the essential facility doctrine can apply. The Court of Justice doesn't use the terminology of essential facilities. That comes from US antitrust law, but it's so embedded that, in fact, the advocates general do use that terminology, so I think we can use it here as well. The standard case law is the Bronner case, although we have some prior case law as well, but Bronner is the leading case, in which the court made a rather subtle balance by stating that when there are dominant players in the market and they do have resources which are indispensable, and the term is indispensable, then a decision to refuse access is in breach of Article 102. Refusal and indispensability is a very, very high threshold. And it's so high that, in fact, in the Bronner case, the case was finally dismissed. And we don't have many cases in which we can see how that threshold is met. Now, the issue is that the threshold is so high that there are doubts as to whether the threshold could be lowered down to certain situations in which indispensable resources, not because they are rejected in full, but because they might be implicitly rejected by imposing burdens that make it so difficult for the competitor to access that resource, that would be sufficient to meet the Bronner test. That has been the discussion that's been ongoing for quite a lot of time. We've got the answer 2 years ago in the Slovak telecom case, in which the Court of Justice confirmed whether implicit rejections are covered by Article 102 or not. And the court said no. And therefore the threshold is the Bronner threshold. Now, why? Well, the rationale for Bronner is very nicely explained in the opinion of Advocate General Jacobs, which I really recommend everyone to read, because in beautiful simplicity explains a very complex matter. And it basically comes to the conclusion that to impose on a market operator a duty to provide its resources, it's such an aggressive restriction of its freedom to undertake a business that it should be handled very, very, very carefully. And it should be handled in such a way that only in very significant situations of market fragmentation should be justified. And that's the same rationale that the court is applying now in Slovak telecom. Understanding that implicit rejections of access to an indispensable resource of a dominant player are not in breach of Article 102. Now, what we are seeing in the context of payment systems is that when we fear that there might be situations of refusal of access to a resource, and here we go back to Article 35 of PSD2, implicit situations in which a market player, of course, will have some difficulty in finding a dominant market player, but just think of situations of collective dominance of some of these market players. In those situations, we will not find rejections of access because they have a duty to provide access. What we will find are the introduction of burdens to access. And those situations of burdens to access, which were considered that could fall under this idea of implicit rejection, now they do not come under the 102 test, at least after Slovak telecom. So as you see, many issues are there to ensure a level playing field in the payment system. And just as a way of conclusion, I would like to just make two or three points. First point, the payment systems market and its framework under EU law, it's showing that at the moment we need to take into account that when creating a specific area or a specific market in the internal market, we don't just have to look at issues of efficiency and effectiveness in the construction of a market. We have to take also into account certain values. And we have to take into account, in particular, us as lawyers, fundamental rights, which are the way in which we incarnate values in our legal system. And as you have seen, some of the issues of how to ensure that level playing field entail the consideration of certain issue of value, going beyond the effectiveness of the system. And that's, for example, what the Bronner and the Slovak telecom case law shows us, that, okay, we might have issues of access in the creation of that market, but the duty to impose access to an essential resource which is owned by a market player is something that has to be handled very carefully. What are the incentives that we are creating for those market players who are investing to create those resources if we now impose duties of access to those resources? So eventually, issues of values are important, whether the final policy decision might be. And secondly, that there are issues also when it comes to certain areas which go beyond specific general horizontal values, but which are value relevant elements. And when we come to the financial sector, there is a particular value which is highly important from the perspective of EU law, which is financial stability. Financial stability, it has been recognized by the Court of Justice in a seminal judgment in the case of Pringle, plenary judgment, that financial stability is a higher objective of EU law. This means that in the field of financial services, the protection and insurance of financial stability as such is a higher objective of EU law, even higher than the general objectives in that field of policy, which we will find in directives and regulations. So there are horizontal elements of value which we need to take into account in creating a level playing field, but we also have sectoral elements of value when we come to a specific sector, as is the financial sector. And then finally, the last point is that we also have issues of digitalization. And I've been speaking of payment systems in general, but of course, what we are heading into is a digitalized payment system framework. And in that context, we need not just to think about values, but we need to think about the broader picture of what that entails. But of course, that goes way beyond my 20 minutes. Thank you very much.
Thanks a lot to Professor Sarmiento. Now we have a short break, but we reconvene precisely at 12:30 because we have the keynote speech of the Deputy Director of the Bank of Italy, Dr. Cipollone. Okay, 1 second, please. We now have the keynote speech of Dr. Piero Cipollone, Deputy Governor of the Bank of Italy. He is presently in Washington, D.C. for an international conference, so we give him immediately the floor. It is pretty early in the morning in the States. Thanks you, Dr. Cipollone, for being here with us, and we are here to listen to you.
Good morning, everyone. First of all, my apologies for not being able to be there, but unfortunately, when the meeting was set, the date for the spring meeting were not yet available, so we mixed up a little bit the agenda. Despite that, I'm very happy to be there, and I want to thank Concetta and Cecilia for inviting me to be part of this distinguished group of speakers. I have been listening since the beginning of the conference, and I found it very interesting, really very interesting. And despite the early hours here in the US, I was able to follow everything. So thank you again. I will make some remarks on the path toward PSD3. The payment sector is a key component of the European single market. And because of its lingering fragmentation among national borders, it has been the focus of several technical and regulatory interventions in the past, aimed at improving the harmonization among member states. During this journey, PSD2 has been a landmark. It has brought about a great harmonization and competition in payment services. However, 2 more milestones need to be achieved before we can claim the creation of a true single EU retail payment market. First, we need to complete the job and thereby allow innovation to be as disruptive as it was meant to be in the PSD2. Second, we need to embed in the regulation the dramatic changes in the technological landscape since PSD2 came into force. As for completing the job, there are at least three hurdles that need to be overcome. First, the lack of full harmonization and complete application of the rules across member states. As a matter of fact, the payment services framework still needs to be fully aligned with the other EU policy and regulation. I am referring in particular to GDPR, to the Electronic Money Directive, and to the MiCA. Second, the cost of the payment services is still too high. It can be further reduced by fostering strong competition within and across member states. Third, the role of technological providers in the payment sector still need to be clarified. This was for completing the job. Let's move to the second issue. How do we take into account the technological shift? Remember, we should consider that PSD2 entered into force in Italy in 2018. Back then, words like smart contract, DeFi, consensus mechanisms, DAO, DLT did not even exist. And when they did, they were unknown to the most of us. Today, they are part of everyday jargon, and they have made their way into important piece of legislation. As a matter of fact, the pilot regime entered into force on March 23rd. This is a legal framework that supports those who want to use DLT to issue, trade, regulate, and store assets. With the decree enacted by the Italian government on March 17, Italy was able to make the needed adjustment to its domestic legislation so that our financial industry can take advantage of the pilot regime. This new technological landscape offers many opportunities to develop new payment solutions that can improve general welfare. Whether this potential will be realized or not, it depends on the way we design and implement PSD3. However, because of the new technological infrastructure underlying the payment ecosystem, we cannot proceed with the same mindset that guided us in the past. On the contrary, we need to be creative and to approach the drawing board with three pillars in mind. First, we need to rethink and try to solve the eternal question of whether to regulate entities, activities, or both. Second, we have to have in mind that the whole system, the whole ecosystem is evolving continuously and swiftly. Third, we need to promote a public-private partnership aimed at design a pro-innovation regulation. In the rest of this speech, I will elaborate on these 3 points a little bit. So to answer the first question about who or what should we be regulating, I think we should first and foremost grasp the profound implications of the new technological environment. For me, the most striking feature is that the supply chain of a payment services is increasingly being fragmented among specialized and interdependent actors, bounded together in the structure created by the technology, even in the absence of any contractual relationship among themselves. To make clear what I'm trying to say, let's recall that before PSD2 came into existence, the main actors in the field of payments services were traditional PSP, I mean banks, electronic money institution, and payment institution. And the regulation was centered on these entities. PSD2 has contributed to bring the exclusivity of bank-customer relationship to an end. It allows new players, such as third-party providers, to offer new services to their customers, namely the so-called open banking services, without having any contractual relationship with the incumbent payment services providers on whose books those clients hold their savings. As a matter of fact, PSD2 laid out a regulatory framework establishing that payment services provider have to grant access to payment accounts to the third-party providers through technological solution known as APIs. Here we can clearly see the innovative and disruptive potential of PSD2 and how it was able to foresee well in advance the technological leap that the payment industry could make for the benefit of the whole financial world. As a matter of fact, in the open system, the technological standards replace the traditional private rules, such as the agreement underlying the card scheme, for example, and became technological law themselves. This is why, in the context of open banking, agreements are not only unnecessary, but they are even forbidden. It's the API law that regulates relationship between parties that do not even know each other and that can trust each other only thanks to the digital guarantee offered by the technological standard. This is, I think, the path that will lead from open banking towards open finance. These technological interdependencies will be equally stronger for payment solutions and financial services developed on a blockchain platform. We then need to ponder the consequences of these new technological paradigms on our regulatory framework. The traditionally supervisory and or oversight approach, which postulates responsibility that can be tracked back to the specific entities, is no longer fit to meet the challenges posed by this new fragmented ecosystem of entities. It is therefore important to go beyond the single entity dimension and to consider how to factor the relationship between subject, infrastructure, tools, and services into the new regulatory framework. One way forward is to think about a product-oriented approach. Thereby, all entities involved in the supply chain of a payment services, as the provision, for example, of a digital wallet for payment transaction, need to comply with the core principle underlying the oversight of the payment system, regardless the existence of a contractual relation among themselves. This approach is in line with the new Eurosystem oversight framework for electronic payments, electronic payments instruments, schemes, and arrangement, the so-called PISA framework, which is applicable as of November 2022, which is important because it has introduced two significant innovations. The first innovation is that it goes beyond the traditional notion of a fund transfer, while it embraces a much bigger and much wider notion, which is the notion of value transfer. So, and in this way, it extends the scope to the digital payment tokens. The second innovation brought about by PISA is that the new framework also targets not only traditional payments scheme, but also arrangements. thereby bringing the complex dimensions that characterize the new digital ecosystem under the overseas competencies. So this is a somewhat lengthy discussion about who and what should be on the regulatory radar brings me to my second pillar, which is the need to constantly bear in mind that we are dealing with a very dynamic ecosystem. Therefore, while we are looking at the current supply chains, and in particular at their single components, we also need to monitor how they evolve over time, and more importantly, whether new ones are established with the aim of providing new services or old services in an innovative way. I have in mind, for example, all micropayments, machine-initiated payments, and payments in real time using online services. Continuous monitoring of the current ecosystem is therefore pivotal to design regulations that are flexible enough to be future-proof, so to speak, in an attempt to accommodate the continuous flow of innovation. Finally, and this is my third pillar, we must ask ourselves whether we, as regulators, are fully equipped for the daunting task I have tried to sketch out so far, or whether a closer interaction with the payment industry might be useful. To be frank, we do not know a great deal about how to regulate areas where the boundaries among activities and subject are blurred. These are uncharted waters for us, and a more prudent approach might be wise. Therefore, in addition to the rule on entities and activities and to the oversight framework on payment system and services, it might be wise to rely on a soft regulation based on the definition and standard and practice developed according to the logic of public-private collaboration. This collaborative mode could ensure a sufficient degree of adherence with respect to the ongoing technological developments. A practical example of this approach is represented by the protocol that Bank of Italy has signed with two important Italian universities. One is Roma 3 and the other one is Cattolica di Milano, to explore the role of smart contract in DLTs and to provide a basis for the development of technical standards and rules to be shared with those who, like developers of algorithms, are outside the traditional perimeters of intervention of the regulatory and control authorities. The first set of results of this work will soon be made public to collect observation and suggestion from all interested parties in order to be able to proceed to the most important phase of the work, which is establish good principle. To conclude, the retail payment industry is an incubator of innovation. Central bank and supervisory authorities can play a key role in ensuring that the positive externalities of innovation benefit consumer and business alike. The Bank of Italy is actively involved in this process by monitoring market developments, interacting with market operators, and supporting the early adoption of digital technology by the financial market. Thank you all for listening.
We are most grateful to Dr. Cipollone for this very important speech, which gives us a point of view of an important national regulator, but as we know, the sort of all central banks are very much debate among themselves, and I'm quite sure that what Dr. Cipollone has told us is not relevant only for the Italian scenario, but for a much broader scenario, especially at a European level. Having said this, I will give the floor to Professor Paglietti for our intervention on each on maximum harmonization and general private law and payment services market, after which we shall have a brief question and answer session.
Thank you, Mr. Chairman. And I would like to take the chance to also express my sincere gratitude to Piero Cipollone, Deputy Governor of the Bank of Italy, who has been so kind as to participate remotely from Washington, D.C. His expertise and insights are invaluable, as well as his willingness to connect from another time zone altogether. So this being said, I would like to starting from the title of this conference that heralds the PSD3 and the possibility of a reform of the legal framework. I would like to deal with the issue of the rules governing the allocation of legal responsibility in the event of the unauthorized or erroneous payment transactions, and consider whether there is a need for regulatory. If we look at the debate on the possible revisions of the PSD2 in this field, we can identify two constant needs and objectives: consumer protection and consistency in application. Consumer protection, because of the continuing markets have continued to evolve, and consumer protection remains an issue in payment law because we have new payment methods. Let's just think about digitalization, mobilization. We have new risks, security risks for electronic payments, and also we have new political trends because we are assisting to the development of a policy of differentiation between groups of users. So we have corporates, we have micro enterprises, and we have consumers, and among them vulnerable and non-vulnerable consumers, the latter of which refers particularly to elderly in the payment field, as Professor Cheredchenko remembered us. As in application and enforcement, as already mentioned during this morning, we have, despite the full harmonization legal framework, interpretation and application vary between national systems. Different interpretations of the rules lead to regulatory fragmentation, already remembered also this morning, and across the single market, which is one of the main obstacles preventing the PSD2 from fulfilling its objectives. And the risks of fragmentation are that of forum shopping, regulatory uncertainty, altering the level play field, and making the competitive scenario more uncertain. So I think that guarantee of a high level of consumer protection and consistency in application can be ensured in this field by resorting not necessarily to regulatory innovations, but rather to interpretative. How? By working on two levels: a proper reconstruction of the relationship between special supranational rules and general domestic private law, and open texture of nature of PSD2, so co-presence of general clauses. Proper reconstruction. As mentioned this morning, the regulatory framework for the allocation of losses in cases of unauthorized payment is a kaleidoscope, and we can call it a kaleidoscope of rules, which is the result of the cooperation between several levels of the legal system. We have legislative level rules, level 1, the directive and the relevant national transposing legislation. We have regulatory acts level 2, those of the regulatory agencies, and also we have the pre-existing general internal rules on intersubjective relations. And in regulated markets, such as the banking industry, the relationship between European rules and general domestic private law in the context of a maximum harmonization directive such as the PSD2 is highly debated and is part of the current debate on the pluralism of sources. And I think that inconsistency may be avoided through a proper reconstruction of the relationship between national law and European law. In fact, if we look at the case law, the domestic case law, the main source of fragmentation is the multitude of domestic law additions. In cases of fraudulent or erroneous payments, the PSD2 basic rule is that financial institutions bear payment losses unless they are caused by consumer gross negligence or fraud. The model chosen by the European legislature therefore encompasses principles that are extensively shared in the theory of business risk, effectively assigning the damage to the party that appears most able to bear the relevant costs and absorb the economic impact according to the theory of Calabresi's cheapest cost avoider. In a recent judgment already recalled this morning, the European Court of Justice answered the question whether the allocation of liability in the case of unauthorized payments is exclusively regulated by the directive, leaving no room for national legislation, or it should instead also be subject to other regimes of liability that stem from rules situated outside the regulatory framework designated by the directive and delegated regulation. And the decision states that the matter is regulated exhaustively by the directive, rejecting the continued application of domestic regulatory additions of general private law. Specifically, the court establishes that the time limits for triggering the liability of the provider are only those specified in Article 58 PSD. In cases such as this one of exhaustive harmonization, a rule that does not conflict with the directive, but which is instead premised on a further and concurrent scope of intervention must also be disapplied. So the solution in terms of substitution, not competition, of the relationship between a European general domestic law guarantees a higher degree of harmonization, avoids a divergent application between jurisdictions, closes a rift for the entry of the localism of the enforcement, while admitting a dual liability regime, finding its sources in rules internal and external to the directive, would have exposed the PSP to the risk of being considered for the same conduct as fulfilling regulatory duties and failing to comply with general law standards of care. Open texture nature of PSD2. PSD2 has a typical characteristic, which is the peculiar legislative technique. The European legislature has opted for recourse to general and wide-ranging clauses alongside the use of specific rules that dictate detailed and stringent obligation. When it comes to regulate the characteristics that a strong authentication system must have, the directive uses the technique of typifying in detail the conduct that the merchant must adopt in setting up a security system. On the other hand, when the directive describes the conduct that the user should adopt, it refers to the reasonable steps that he or she should take to keep safe his payment instruments and personal security credentials. And also, the directive refers to the user's gross negligence as an exception from the strict liability imposed on institution. So this structural model, which is typical of the European legislation, let's just think about competition law. It's characterized by a high degree of regulatory detail alongside the use of open texture rules, which makes it possible to regulate a large number of cases, gives the legal framework flexibility, allows the prevention of obsolescence and of the need of continuous regulatory updates It's a form of future-proofs norm, as Deputy Governor said before, and allows the setting of different levels of protection and liability based on the user's particular degree of vulnerability, as relating, for example, to elderly people. So I think why this kind of allocation model and also of legislative technique might work also in the context of further innovation, such as the transition to Web3. But of course, the use of general clauses broadens the margin of discretion, and these are the cons of the general clauses, because they broaden the margins of discretion of the judge and therefore of arbitrary choices, presenting consequences on the jurisdictional or quasi-jurisdictional, if we talk about ADR mechanism review. Consumer associations and stakeholders claim that several inconsistencies with PSD2 are related to the liability regime related to unauthorized payments. As previously mentioned, the basic rule is that financial institutions are responsible for payment losses unless they were caused by consumers' gross negligence or by fraud. If the customer is grossly negligent, the financial loss is shifted from the financial institution. So this raises the issue of the legal standard of gross negligence needed in order to avoid liability. The definition of gross negligence thus appears to be decisive for the sound allocation of the risk of unauthorized payments. So PSD2 does not define gross negligence, but it offers some guidance. Recital 72 says that gross negligence is a conduct exhibiting a significant degree of carelessness, and also gives an example: keeping the credentials used to authorize the payment transaction beside the payment instrument in a format that is open and easily detectable by third parties. And also, the Recital 72 says that assessing gross negligence on the part of the payment service user, account should be taken of all the circumstances. So, how interpretation and application vary between member states? First of all, if we look at the concept of gross negligence, it doesn't really differ among member states. What really differs is the level of diligence demanded. Because if we look at the concept of gross negligence, it is commonly intended as to be a higher standard than the standard of negligence, so more than just carelessness. And these are many references across the member states. But inconsistencies might be found when it comes to assess what level of diligence demanded from the consumer. And in these cases, we have differences between member states, depending also on the tradition of those systems. In France, most cases concluding that the victim was not liable because they were. France is a system with a solid consumerist tradition, and so the judges in France used to decide the cases affected by the cultural approaches of related field, in particular, in this case, consumer law. In Scandinavian countries, on the contrary, consumer conduct has been assessed by high standards, so in most cases concluding that the victim was liable. But this was almost in the past, because nowadays, when everybody's more familiar with payment instruments, and the courts or ombudspersons have been deciding on the matter for a long time, differences in assessment seems to be reduced, and we can find large areas of convergence in assessing the user conduct among different legal systems. So, for instance, in card present frauds, we have a common example of gross negligence, such as keeping the credentials beside the payment instrument, keeping a payment card in a place which is accessible to third persons, typing the credential knowing of being watched, and the short span of time between the thief of the card and the execution of the unauthorized payment transaction. In card non-present frauds, such as phishing, smishing, phishing, spoofing, and SIM swap fraud cases, there are even more areas of convergence and shared principle. In most of the member states, and the decisions body had decided that every reasonable user knows by now, or at least should know, that the secret code of a payment instrument must not be communicated to any other person, and that every reasonable user should behave when dealing with payment instruments with a minimum self-responsibility and be aware of the risk of cyber attacks. And also that falling for a fake email or text message or phone call disclosing security credential and one-time password is not considered a conduct grossly negligent. Also, courts and ombudsperson's assessment differs depending on the level of sophistication of the fraud. So we have common examples that exclude gross negligence. In sophisticated frauds, gross negligence cannot be attributed to the customer due to the insidiousness of the means of the attack. Non-recordability, such as for example, in phishing cases, receipt of an email bearing a perfectly reproduced logo of the intermediary excludes gross negligence. So, general clauses and consumer vulnerability. The use of general clauses, I think that also allows courts and ombudspersons to set off different levels of protection and liability based on the user's degree of vulnerability and having regard for payment service users different level and of financial and IT education as bearing, for example, on elderly people again. This is a new need related to the new consumer policies and pointed out also by the study on the application and impact of the PSD2, which suggests that the same behavior should be assessed differently depending on the specific vulnerability of the consumer involved. The extent of the gross negligence and so the level of diligence requested should be graduated in virtue of the vulnerability of the consumer, especially the age. So to conclude, I think that instead of changing the legal framework, level 1 legislation may remain as it is for the reasons mentioned above, and level 2 legislation may clarify the concept of gross negligence, explicitly mention example of behavior that constitute gross negligence or exclude it. Thank you.
Thanks to Professor Paglietti for this further contribution to clarifying what should be done, can be done, and what is expected can be done. Now we have at least a good quarter of an hour of question and answer. I would ask our previous speakers, Professor Sheredinenko, Professor Geva, Professor Everson, Professor Sarmiento, if they can come here and sort of see if there are questions among themselves, first of all, and from the floor. We have quite a rather rich floor of participants, so I know Professor Sheredinenko wants to intervene, but maybe she was very disappointed we didn't immediately have the. No, the point was that simply we had to be connected with Washington, D.C. Can I just first see us from the public, from the distinguished public, if there are questions to the speakers? Yes, go ahead. Sorry, I don't know whether there's microphone. Yes, you can, but I don't think there's only one person who's connected, so I don't know. No, go ahead. Loud voice. If you could, everybody who is not well known in this, if they can say their name and affiliation.
Yes, thank you. So, as you said, average consumer, so we have to find some solution to this. And vulnerable consumers issue. The scholars are still about, parameters, criteria to use the margins of discretion of the judge and the courts. And this is why we have been so much referring to age, because that is a very certain criteria. This is, of course, elderly people have generational barriers, even if they are not affected with cognitive deficiencies or social isolation. Elderly people may experience and usually experience generational barriers dealing with IT. And so one of some scholars think that the industry should avoid to offer particularly sophisticated products to elderly people because they don't know how to manage them. And at the same time, this is a benchmark which is very easy to detect, to discover, because age is something that is also very easy to know, because every time you sign a contract, you have been asked for name, your surname, and date of birth. That's it. Not very interesting. So the debate is ongoing, but I think that age is a good criteria. Among the other criteria, is one of the best, and one of the more sure to assess.
I may add to that. I think and the issue here is the role of the EU in harmonizing the concept of context of EU, because what we see now, of course, member states have quite considerable room for maneuver, and they can raise the standard and protect the vulnerable. The question is, what would happen if now with the revision and sets a certain standard also of vulnerability based on the maximum harmonization directive. I think you mentioned also that it could be wise to specify, well, at level 2 what it means, but this could basically result in the degrees of protection and maneuver at the member state level. So I think this is a very delicate balance, always, particularly when the EU already intervened quite significantly in the private law domain in harmonizing liabilities. How much of that do we want? And it can perhaps, I don't know whether there is research also that maybe vulnerability also differs across member states, that there are different types of vulnerabilities, and that's why I think we should be careful with applying the one-size-fits-all approach and top-down direct from the EU. But again, this is a very well interesting and delicate issue.
Thanks very much. That's an excellent question. There is a reality with regulatory or administrative branch, because you see it in the States as well, that the constitutional position, so 1930s, the massive increase in agencies, including something like the FBI, the 1930s. There's no place within the American Constitution for them either, and they remain. It is the reality of administration. You always have an ad hoc development. They remain objects of political discord. Political discord is generally around the Administrative Procedures Act that you have. That President Trump gave an impassioned speech in the middle of his madness about the Administrative Procedures Act, and you're going, what's going on there? What's going on? But that's the attack on perceived left-wing regulatory agencies from the 1930s. So it's never unusual. In the EU, the basic problem is this balance of powers principle. And a few weeks ago at a conference, I heard again from the legal services that they hang on to Moroni. They hang on to that Moroni doctrine that says every named institution in the treaties must act within its own competence. That's an absolute, I was a bit surprised the vehemence that came out the legal service. And that presumably is to protect the member states versus European institutions. In the agency field, it means that we have a very big problem whereby the Commission is responsible for all agency acts. The agencies can't be recognised. The Commission becomes responsible for all agency acts, which gives the Commission a reason always to be running after the agencies. It is scared ultimately of being held responsible for their failings. At the same time, it wants the agencies to distance itself from decisions. So we get that problem. Then with the European Central Bank, it's a named institution. The obvious tensions with the European Banking Authority, which is not a named institution, are also there. How do we solve that? Treaty modification, an agency article in the treaty, but then you are admitting to the world that you need a technocratic arm. And the tension between and that's not just the EU, that's for everyone, the tension between admitting you need a technocratic and democratic process. I suspect that's never going to happen, so we will always live in this. But does it matter? Does it matter if the American experience is anything to go from? I mean, you could even say it's positive, but you've got a pluralist approach to power exercise. So, not a perfect answer, but the best I can do for you.
If I just may add.
I just wanted to add a comment to the previous question. One better than the other. On agency, being a realist, I think that we need to take into account that the Commission has 29,000 staff members, more or less, 29,000. The city of Madrid, where I come from, has 50,000 staff members. So the Commission is running Europe with half the staff of the capital of a city of a member state, of a medium size. So playing the realist, I think that we had to take into account that for the Commission to run Europe, quite a challenge to do it with 29,000 staff members, which sounds like a lot of people, but in fact, yeah, but the problem is that we're asking them to do more and more and more. But that's not what's happening, unfortunately. So. Yeah. But we are legislating more and more and more. And the more we legislate, the more things they have to do. Yeah. Yes, but we can't have it all. They can't have it all. So that's something we need to take into account when it comes to reality of agencies in the EU context. We have a very poor administrative arm in the sense of resources. Are kind of an inevitable thing we need to live with. On liability of agencies, there is a fascinating example of an agency that has legal personality and that is liable, fully liable, which is the Single Resolution Board. It has a budget to assume its liability, and that liability is stated in a regulation. At the moment, you to know, there is an incredible case in which the Commission and the Single Resolution Board are litigating on appeal to get clarity as to who actually resolved Banco Popular, the first bank that came under resolution, because they don't know who resolved the bank. And that's a different story. That's a different story. In order to resolve a bank by the SRB, the Commission has to endorse the SRB's resolution decision. And that endorsement is what makes the system Meloni compliant. And as long as the Commission endorses the SRB's resolution decision, then the system is Meloni compliant. And what happens? All the shareholders of that bank challenge the SRB's decision, and other shareholders challenge the Commission's endorsement. And the General Court missed the actions, but in both cases, it ruled on the merits. So the General Court gave a message, or gave the impression that they were both resolving Banco Popular, but not jointly, separately. So now we have an appeal before the Court of Justice on who has passive standing to be sued, whether it is the Commission or the SRB in the context of bank regulation. So the Meloni implications go also into very complex procedural matters which touch into the heart of Meloni. And the second comment on the definition of permanent legal concepts. The problem with defining legal concepts level with directive is that we are stuck once we have the concept in a directive. We are assuming that at some point there will be made going to be the justice directive. The problem is that those decisions of the court are always going to come in response to a request for a preliminary reference. And on that procedural context, the court will always be limited to what it can find. And in terms of defining an actual concept, it's very difficult for them to give specific indications, such detail that can eliminate any discretion for the national court. Very, very difficult. And I think that's when the failure to have specific concepts definitively settled in reference rationale. And that's something that doesn't happen at the national level. Eventually, a case court has all the tools, fact and on case. It only has the tools, not on the facts, and that ties the hands of the court. So I'm very concerned every time that we have a new concept in perspective of regulation that it's obvious that the legislator didn't have the time or political capital going to further, assuming that it's going to be justice is going to be final definitive scope to that provision, because the result is that generally that is not the case. Usually the legislator exactly. Together.
Um, if I'm allowed just to make a final comment on Professor Emerson, I sort of I felt very much in line with the sort of not specific positions, but the topics she touched, which I feel are fundamental for our understanding of this and many other fields of EU law. Professor Emerson repeatedly spoke about sovereignty. It comes to me that in your next slide you should put in wonderful sovereign. Sovereign. Yes, a real. So I mean, we're talking of money. I mean, sovereign is worth a great deal of on the market. You sell it, and it has a great deal of value. So just sovereignty. But what I want to say about sovereignty, looking at a very realistic approach, seen from the EU perspective. First of all, what is the sense of handing over all this information to Visa, MasterCard, and American Express? Now, if we talk about competition as if we were sort of Alice in Wonderland, yes, okay, that's part of competition. But from a strategic point of view, I don't see very much what is the sense of this. I don't see very much what is the sense of giving even more strength to. I'm a capitalist. I'm in favor of capitalism. I'm probably nearer to Donald Trump than to Joe Biden. But I don't. I'm sorry. No, but I mean no, but not from an economic point of view. From an economic point of view. No, but just a point from that point of view, it seems to me that it's we don't have to be sort of naive or hypocritical. I mean, what is the sense of giving even more power to Amazon and to Apple Pay? Well, you do these instruments. I mean, it's not that some new startup is going to enter the market. It's the big players who already have data and who are entering this market and going to have even more power. And then we're going to having opened sort of the market to these data market, financial data market, to these huge players, then we start saying, hey, what have we done? Now we must cut their, and we must limit their possibility to enter the market. Third point, again, on the issue of sovereignty, Dr. Cipollone mentioned blockchain. Personally, from a sovereignty point of view, I do not see why on earth should the European, the Euro system, which has its significant fragilities for reasons that we all know, should somehow use, when it comes to digital currency, use a technology which is not controlled by itself. It is, to my view, very, very obscure, and that I don't think this is blockchain technology is something that should be easily taken. It can be taken by all those who want to do speculate and play with blockchains, with cryptocurrencies, but not surely with a central bank, European central bank. Yes, yeah, go ahead. Just to point out, I think blockchain is something for, if you want to gamblification, yes, it's fine, but for a digital currency, no, it's issued by a central bank. No, it should be a trusted system which is not given to someone else.
allow payment one device to another without any intervention. And it's just exactly like you buy the banknote. Bank, you buy it from the bank, then you will pay you, and well, if you want to deposit the bank, it's okay, but there is transfer. And I see this is a lot of studies about problems with paying other systems. Yes, Bank of International. I, I just find that I'm not optimistic. I am optimistic. Too much emphasis on techniques transfer of message. Transfer your message or will wake up out tomorrow, and you are able to discover it later, then tough luck. The world already out and you didn't know about it or you didn't plan. But if you're talking about currencies, after 10 years, whole financial system, that is all use of time for transfer messages, currency of my mind is static.
No, you had the comment. You had sort of first comment. Maybe I missed the point, but as he mentioned among his speech, and maybe I misunderstood, but it seemed to me that there was a mention on sort of on the use of blockchain in this environment. Okay, thank you. We've gone well beyond the expected time, but it was good having this debate, and we have a lunch break, and we reconvene here at 2:45. Yes, sure. Yes, sure. I mean.
We need to start the afternoon session after the very, very interesting, really very fruitful morning session in which we have debated important topics on the architecture of the regulatory structure in this field. Now we are going to discuss specific aspects of the current regulation and in the perspective which are the main weaknesses that the last report of the European Commission detected and which are the progress that are envisaged in this, as we know, we call PSD3, but probably it does not exist currently, so we are speaking PSD, we don't know. But for sure there will be some changes to fix some points that are not properly established, and for this reason we will try during this afternoon to understand which are the main points still debated, and with the afternoon session will be concluded by Professor Andenas, that is an prominent professor of this field and an expert since a long time. We met many years ago, and we will still debating some aspects so of the financial regulation. Let's start. Unfortunately, not all the speakers of this afternoon were able to attend in person the conference. Maria Cecilia and I made the best effort to have all you in presence, because we consider crucial to have a frank discussion that is possible only when we are in presence, and also the exchange of views is completely different, and so we made the best effort to do so, but it was not possible for everybody. But we would not have missed the precious presence of some experts of these fields, and so we are happy to introduce this afternoon speakers, starting from Dirk Houbrick. Dirk Houbrick is the Head of Conduct, Payments and Consumers Directory of the European Banking Authority. This morning we discussed a lot about the role of a regulatory agency within the European context, and now we have the presence of the person that is in charge of this regulatory task, and so we are very happy to hear from him what is going on at the European Banking Authority regarding the PSD, the change between PSD2 and the future regulation of payment services. So please, Dirk, the floor is yours. If you are connected, I see you. Yes.
Yes,
Thank
hello,
you
good
again
afternoon.
for having accepted our invitation.
Well, I hope you can hear me, and thank you very much for inviting me in the first place. Are you able to hear me?
Yes, we are.
Perfect, excellent. I did attend earlier session. Just for you to be aware, I will only be able to hear things that are said when the microphone is on, because all the conversation that happened in the room while microphones were off were actually we were not able to follow. So just as a remark. So thank you very much for inviting me. I really apologize I'm not able to attend in person in Rome, but we found the topic of the conference so interesting that we were very keen to attend the conference, including also the other speeches that will be given after me, which are all very pertinent, very important. So I didn't follow all of the conversation that you had apparently this morning about the role of supervisory agencies, so I'm not quite sure what issues were discussed. But I have some insight that I can bring to the table. As you kindly introduced me, I'm the head of conduct, payments and consumers at the EBA. I've been at the EBA for quite a while, did lots of work before in other areas, in the private and also in the academic sector in Oxford and London. But at the EBA, we have been working a lot in the last 6 years on PSD2. When PSD2 came out, I think we realized that it wasn't the best and most clearest level 1 text that has ever come out of Brussels, and created lots of questions and interpretation issues. And of course contained also mandates for the EBA. There were 12 of them, 6 technical standards and 6 guidelines, which we developed 4 or 5 years ago. And then we made sure that these guidelines and technical standards are properly supervised by the 27, at the time 28, but now 27 national authorities, and properly complied with by financial institutions. So that was an interesting journey. And I think if we are now talking about the move from PSD2 to PSD3, it's probably worthwhile to remind ourselves what paradigm shift actually the PSD2 was, and that PSD3 will now be building on. So if I could ask your colleagues maybe to just move to the next slide, which will show a little bubble that you see here on the right. Several bubbles, in fact, the objectives of PSD2. What did the PSD2 to achieve? And I think we just need to remind ourselves to really understand the complexity and the challenges that both the EU Commission, as the initiator of the directive, as well as the Council and the Parliament, and then also the EBA and the national authorities faced, which is that there were quite a large number of objectives in the first place, and that the directive was the first directive that was ever issued with a very explicit pro-competition and pro-innovation objective. But these were not the only objectives. So you see this on the slide, in that graph here on the top: enhancing competition, facilitating innovation to its right. But there were also others. If you go towards the left, there was about the strengthening of security of retail payments, the protection of consumers more widely, both the payment transactions as well as the data of consumers. The directive aimed at contributing to a single EU payments market, because the market is still rather fragmented. And to remind you what it means, a single EU payments market means that as an entity, as a legal entity, you can get authorizations in any EU member state to be whatever you may want to be: a payment institution, electronic money institution, account information service provider, whatever. And you are able then to provide your services into the other 26 member states without additional supervisory hurdles or a particular national law specificities that you will have to comply with. No, that is not a single market, and the PSD2 was keen to contribute to that single market and achieve that objective. But also then promoting customer convenience, if we go in that circle further to the right at the bottom. So payment transactions should also be easy for consumers to actually carry out. And then doing all of this in a way that is business model neutral and technologically neutral, so that we are not preemptively either promoting certain technologies or preventing certain technologies. So, and to achieve all of that was rather challenging, because some of these objectives are actually competing with one another. So they are creating, they are putting basically an organization, a supervisory authority like the EBA, into opposite directions. I mentioned one example here: promoting customer convenience, the bottom right, and then strengthening security. Yes, of course, we can develop security requirements that might then be extremely secure to ensure that there is no fraud and no misappropriation of funds, but that will then be very inconvenient for consumers to actually carry out in the first place. So here's a trade-off where we were pulled into opposite directions, and we needed to make a trade-off. And where exactly that trade-off lied, we went into consultation with all of our technical standards and guidelines, proposed to the public where we thought the balance would be, and then we looked at the responses that we got, and we went through every single response to assess what are the merits of these responses, of these views conveyed to us, and should we actually make amendments to the technical standards and guidelines. And then in many cases we did. In other cases, of course, we didn't. And we have very extensive feedback tables at the end of every final technical standard and final set of guidelines, where we explain how we have made our assessment of the responses we have received. So that was one competing objective. The other one worth mentioning, there are several, but I'll just highlight two. The other one would be the objective of facilitating innovation at the top right and contributing to that single EU payments market. So here these objectives collided when we are talking about access to accounts. So the interfaces through which third-party providers and also banks could be accessing the payment accounts information held in the payment accounts held by banks. And here we had, in theory, the option of developing technical standards that would actually impose how these interfaces should work, that the banks would have to deploy. And we could even then, therefore, impose a single application programming interface, an API interface for the entire European Union, all 4,500 banks and all 2,500 payment institutions, electronic money institutions, and to the extent needed, also hundreds of thousands of agents. But we didn't do so because there's another objective, facilitating innovation, and this is also about the interfaces. And we thought we should not impose a single technical solution. We didn't have the time anyway either, because we only had 12 months to develop this particular technical standard on the interfaces. But we thought, no, this is actually not what the directive envisages. We consider the industry better placed to do that. And we accepted that this may lead to a situation where initially, at least, you have various API schemes, various interface schemes around the EU, and lots of banks going their separate ways. That was a downside, and we addressed that downside in particular ways, but we accepted it. So these are just two examples, and just a reminder, that is what PSD2, the challenge that PSD2 faced, and it's quite crucial to keep that in mind, because it's not a straightforward directive, and we need to, it required us, for example, as you see here in the second bullet on the left, to not only issue these 6 technical standards and 6 sets of guidelines, but also 7 so-called opinions, which is another legal instrument addressed to national authorities and sometimes also the Commission, and also 300 Q&As. So you may be aware that we have a tool whereby external stakeholders, anyone, including yourselves, can send us a question about the interpretation or the application of the law of the PSD2 or our technical standards or our guidelines, and we then provide an answer. And we received since then, over the last 4 or 5 years, 300 of them, which we all responded to, and they're on our website. So there was quite a lot of work involved in that. And it's likely that under PSD3 and any open finance framework, we're going to be talking about open finance later on today, these sort of challenges will re-emerge and might be even bigger. The next slide, please. So to what extent have we achieved these objectives? So let's look at the first one, enhancing competition. Here you can see with a green little dot that I put there, the check mark. We actually consider that objective is well on its way. We have more than 400 payment and electronic money institutions now in the EU that are authorized to provide either account information services or payment initiation services in the EU, which are of course the new types of services that PSD2 brought about. And then we have hundreds of banks that do this as well, but we have no numbers. We do not know because they don't need to be authorized to provide these services. This is part of an authorization of a credit institutions to start with, and therefore by law they are not required to be authorized. So we do not know how many actually use these services, but there are quite a few banks around that are very, very good in that particular market segment. We have also increased, significantly enhanced or provided full transparency of which payment institution, electronic money institutions are operating in the EU, because we have now an EBA central register, which was one of the mandates, 12 mandates that had been conferred on the EBA at the time. And this central register contains all information on all 2,500 payment institutions, electronic money institutions, and I think around 100,000, over 100,000 agents. Including the countries in which they are passporting their services and operating in. So that's a huge amount of information that for competition purposes and transparency purposes is very helpful for any legal entity that would like to enter the market. and is hopefully facilitating entry of into the market and enhances competition as a result. It's also a very popular central register. As you can see here in the second bullet here on the slide, we of course know who is accessing these users in terms of geographic location and so on. So we have around 7,000 unique users. The register is downloaded around 200,000 times every month from around 90 countries in the world. So not only the European or EU member states, but from elsewhere as well. So there are lots of legal entities elsewhere in the world that are maybe considering entering into the EU market, and they're using our register to get some intelligence, and rightly so. And then we've created a level playing field to ensure that the competition is actually on the same level, because we have not only developed these 12 technical standards and guidelines, but as I said, opinions, Q&As, and lots of supervisory work with our national authorities. So that objective is okay. We have strengthened security, the next one further down, and protected consumers. So we have done some initial analysis of fraud data, which suggests that depending on which payment instrument you look at, whether it's credit cards, credit transfers, direct debit, the figures differ between them. But if you look, for example, at card-based electronic transactions, the rate is 40 to 60% down. So 40 to 60% less fraud as a result of the enhanced security requirements. And that's only an indicative number at this, to begin with. We are now getting even more complete data this year. These months, actually, while I'm talking, we are assessing the most recent set of data that we have received. And we expect that later in the year, we'll be able to publish data more comprehensively that actually shows that the reduction is even more significant than this indicative number that we have here. So here, these objectives we consider also to be fulfilled. We facilitated innovation. Yeah, we think so. Consumers are now offered a very enhanced choice of different payment options, with innovation continuing to provide ever more customer-friendly solutions. Not everywhere it works in a super efficient way. I myself, I have 10 bank accounts. I opened 10 bank accounts because I wanted to know what the banks are actually doing, how they're implementing our requirements in 3 countries, and there are huge differences between providers. Some are more friendly, others are less friendly, but that will sort itself over time. We do have an issue though, and that's the reason why there's an exclamation mark, an orange exclamation mark about the customer convenience, because we do see that there are still quite a lot of banks out there that put obstacles in the place of third-party providers and the customers of third-party providers to be able to actually initiate, for example, a payment transactions or to obtain the data from the bank account that they can use. We've taken various measures, but this is still not the end of it, quite clearly, because there's still some undesirable and sometimes non-compliant non-compliant behavior of some of the banks. So we need to work on this. We've remained technologically neutral. I would say, of course, the beauty lies in the eye of the beholder, so it's more for others to judge, but I think we've stayed technologically neutral. We haven't precluded any particular solutions. We haven't encouraged any particular other solutions, technological solutions on how to comply with requirements. But we do see that because we have stayed at a high level, a higher level that we could otherwise have taken as an option in setting the requirements, in the details of the requirements, that there are then therefore lots of follow-up questions. These are the 300 Q&As to which I have referred. And as a regulator, I need to ask myself, is it really good regulatory practice to require the market to monitor what the EBA is issuing and as answers to Q&As every single week? Usually on a Friday at noon, we publish the next set of Q&As that we have responded to. Is that really good regulatory practice for the firms to always have to follow that? I ask myself a little bit that question and ask myself, should we have been more detailed and more specific in the requirements in order to reduce that number and give more certainty to the market? So that's something to be reconsidered by us under potential PSD3. And then finally, the final bullet at the bottom there in respect of account access. Indeed, in the absence of a single API standard, this objective remains unfulfilled. So the fact that TPPs have to develop methods of access to reach the accounts of the 4,500 banks and do this for many different banks in many different ways is an obstacle to market entry and is therefore not desirable. So there's still some work to do. Can I have the next slide, please? I only have 4 slides, and I think the next one might already be the last one. No, actually, I have 2 more slides, but there's lots of text on it. I'll skip through some of it. So some of you may be aware the EU Commission started to review the PSD2. Is expected to propose in June this year to publish its proposal for a PSD3. That's their own plan, timeline, which is already in the public domain. And last year they asked us to provide them with what's called a technical advice. So they sent a letter to us with 28 questions. The letter is public, it's on our website, and they asked us 28 questions about the PSD2, what we thought about the PSD2, and what we think about the need to create a PSD3. And in June last year, we sent to them a 120-page response with a total of around 200 recommendations. 200 recommendations on how the PSD2 should be improved, and we've confirmed, yes, we think there is a need for a PSD3 in order to address some of the issues, because some of the issues that even the EBA has been grappling with over the last 5 years is not because of our thinking, but because of the constraints of the directive or the lack of clarity in the directive in the PSD2 that needs to be addressed. And here I just focus on 3 things. I will not read out every single line that you see here, and I'm sure we can make the presentation available to all of the conference participants afterwards anyway. But I looked at the other topics that will be discussed later on throughout the remainder of our session. And I just focus on those recommendations in our response that cover these topics that my colleagues will be presenting later on. One is the move from payment services to banking, to open banking and open finance. The other one is about vulnerable consumers, and then there's another presentation later on the enforcement of the rules. So I just thought I'd give a little bit of a, for 1 more minute, a little bit of an oversight on what these 3 topics, what we had to say, and what we still believe today. So in terms of the move from payment service to open finance, you see here a large number of bullets that we have recommended to the Commission. We need clarity on the scope of the information that is to be shared with third-party providers. If we then move from payment services to also other retail banking products like mortgage credit or consumer credit, or then go into the insurance sector and the investment sector. So there's lots of data, and which of the data is actually meant to be shared with third-party providers. So that needs to be absolute clarity with that. We need authorization and supervision of those third parties. We need security requirements. We need a clear requirements on consent management, the 4th bullet there, so that customers have control over their data. We need clear requirements on the interfaces. So do we want 70, 80 national authorities in the investment, insurance, and banking sector to supervise the interfaces of tens of thousands of different financial institutions? Probably not. That will not be feasible. So a single interface is probably needed. Clarity on the interplay with the data protection requirements in the EU needs to be sorted out. Clear requirements on liability distribution between financial institutions that hold the data and the third-party provider. So if something goes wrong, who is actually taking a responsibility? Yeah, clarity on the scope of the open finance framework. So at the very bottom, so which account types should actually be covered, which interface types should be covered. So is it only what the bank or the investment firm or the insurance firm provides to its customers via their online, their internet presence, but also what they offer to them via their mobile phone applications? Next slide, please. And that's the final slide. The second topic discussed later on today is about vulnerability and vulnerable consumers. So here, the EBA had observed in recent years that groups of society that are a bit less tech savvy have more or less been excluded from electronic payment transactions because of the way banks have imposed smartphone-based authentication solutions on their customers. You will all by now be familiar with 2-factor authentication, or strong factor authentication as it's called, and the need to authenticate yourself not just through one password but through a second method. And many banks have done so by imposing on their customers, you need a smartphone, you need to download an app, and that app will give you a second code. And then the EBA got dozens of complaints from consumers around the EU hey, my bank has done this to you, I'm locked out of my accounts, and the bank tells me that it's because of PSD2 and because of the ABA, you have prevented, or you are preventing me from accessing my money, which is of course nonsense. There is no requirement in either PSD2 or in any of our EBA technical standards or guidelines that would require that. Rather, it is a choice of the bank, and they have preferred to do that via an app because it's less costly for them to develop an app once and then to roll it out through the Google Play Store or the app directory of applications, and then for every user to do that themselves. But there are other solutions possible that don't require a smartphone, such as a card reader that you have at home. You slot in the card, and the card reader generates that that code. So we have proposed to the Commission, in order to avoid banks playing that game, continue playing that game in the future, that the PSD3 should explicitly say that the banks have to have another solution possible or available for their customers that is not based on a smartphone and not based on ability to use a smartphone or some other high-tech device. So hopefully the Commission will be following our suggestion. This will stay with then through the negotiation process with the Parliament and Council, so that banks cannot play that game and don't and blame the regulators for something that they've just done because it's cheaper for them to do, and that it's cheaper for them to do is my assumption. And then finally, enforcement of the law is also going to be apparently discussed later on by colleagues in this session. The title of the other presentation is about private and public law enforcement. I cannot say about private law enforcement, but I can something to say about public law enforcement. The EBA is, you may or may not know, not empowered to directly supervise any financial institution in the EU. We don't have that power. It's not been given to us. This is a power that remains with the national authorities. The only thing we can do is that there is the supervisory approach chosen between national authorities is consistent, brings about consistent outcomes, and therefore avoids regulatory arbitrage or forum shopping, which is financial institutions going to various national supervisory authorities, trying to find the way that is most, the one that is most easy to be authorized with, and then start offering their services. So we have recommended to the Commission that the national authorities should have sufficient power, should be given sufficient power in the law to get the industry to comply with the legal requirements. We as EBA, we cannot knock on the door of any financial institution, but we want that the national authorities have the sufficient powers to do so. And some national authorities don't. And that needs to change, not probably only in payment services, but in other areas as well. So that's one recommendation. And the final bullet point, and then I stop, is that we recommended to enhance the transparency of enforcement actions. So what national authorities actually do in terms of enforcing the requirements, we would like to be available to other national authorities, potentially also the public, so that we can see this. And that the EBA may be mandated in PSD3 to develop some sort of database on a central database on all of the administrative sanctions and supervisory measures that have been taken in member states. So we'll have to see whether that particular mandate will be given to us, whether there's anything in the PSD3 that will cover this. You all need to be aware, of course, there's very practical and financial constraints. Developing such a database and also the central register of the EBA that I referred to on the previous slide costs money to develop. These are IT expenses, these are process expenses, and very often when these laws are created by the Commission, Council, and Parliament, there is then no additional money made available to, in this case, the EBA or any other supervisory authority to actually fulfill the mandates. So this is a recurring theme, that there are constraints for the EBA and for supervisory authorities to actually fulfill the mandates in full, because there are no additional money made available, no resources made available. We cannot hire additional people that have the required expertise. So we need to make difficult choices and prioritize which ones of the many things that we are required to do are actually the most important ones, given the budget constraints that we have. And with that, I stop. I've spoken over my time limit. I apologize for that, and I look forward to the discussion later. Thank you for the time.
Thank you, Dirk. Really very interesting and with a lot of answers also to the questions the other speakers raised this morning about the role of European authorities. In particular, the last point you mentioned was largely debated this morning because the possibility of having an enforcement public system of private rules, conduct rules, we consider contractual rules, is really crucial to ensure an efficient mechanism to ensure a proper application of the new system. So thank you also for having mentioned the last point, and we discovered also that there are a lot of technical issues that are still to be completed and on which you as the European Banking Authority are working on. And then probably if you are available at the end of the session, probably there could be some questions and answer, or if you prefer, we can just raise the hands in this, if you may stay with us.
I will not be able to stay until the very end, unfortunately. So if you want to spend 3 or 4 minutes now, but I don't want to intrude on the time of other speakers, of course, either.
Thank you. So probably if there are any questions to Mr. Dirk Obrick, probably is the best time to do so. If there are in the audience. Yes, there is one by Professor Mats Andenas, but probably you need to use this microphone because otherwise it's not able to hear.
So come to the front and be exposed to everyone. Sorry for that.
About the parallel processes.
I cannot hear you. You need to come closer to a microphone.
The parallel processes in the other agencies, the other financial markets agencies.
I didn't understand the beginning of the question. Whether there's a similar situation in the other agencies? Is that what you called? What you asked?
Comparable. Anything comparable, bringing up, for instance, private law issues, enforcement issues, the way you described it now with the third generation directive. Then is there any parallel process going on in any of these other areas which are then managed by the other agencies? Insurance.
Yeah, so if you're asking me whether there are other directives, I don't think you're asking me that because I'm sure you know there are other directives.
Whether it's a general process about modernizing a regime which went extremely far in looking at general concepts, a number of issues, balancing conflicting interests, looking at enforcement, and what would you say in terms of parallels in other areas, typically then under other agencies, the other financial markets?
Well, I mean, there's lots of what is commonly referred to as cutting edge topics. A new one that has emerged over the last 2 or 3 years is sustainability, sustainable financial products, the disclosure to consumers about which financial products actually have which impact on our environment. That's all cutting edge in the sense that this is new territory where there's little experience, and it's a learning process for everyone involved. But here there's a EU law that's in place. And then the ESAs, so it's in this case EBA, ESMA, and IOPA, are required and mandated to develop technical standards to provide all of the details on how to make this happen. And sometimes this is very, very challenging, and it faces similar challenges as the PSD2 faced. This is not in the area of competition or innovation, but it is something new, a new service offered to consumers so that they can make more informed choices which financial products they actually want to buy with that additional information. But how do you disclose that to consumers? How do you categorize? Is is nuclear energy a green energy or not? You know, highly political question. And sometimes what happens, because it doesn't have a carbon footprint, but of course it has lots of other environmental impacts if something goes wrong. So suddenly the ESAs find themselves in a situation that such a key political hot potato is dropped in our lap. And we as a technical agencies are required to develop disclosure documents and then come to a view on whether that should be considered a green energy, a piece of a financial product that supports green energy or not. So these processes happen. They are very controversial. We are not supposed to make political strategic decisions as national authorities because we are not elected. We are writing law, but we are not elected by the population. We are just a technocratic agency developing the requirements. So ideally, we would not like to make these decisions, but sometimes these hot potatoes are put in our lap, and as a result, then we attract the political attention with all the good things and the bad things and all the accusations as a result of it that come with it. I think I've only addressed half of your question, but hopefully that was a bit helpful.
Thank you. Professor Andenas is nodding, so was enough clear, and really thank you because you touched upon one point that we debated this morning. So when I told you that you were at the center of the stage of our morning discussion was just for this reason. Professor Everson underlined also this problem that technocrats, if you used this word.
Yep.
Positively, yes. Professor Everson from the audience is saying in a positive way. She used this word, and but some of the decision you make implies some political choices, the degree discretion.
And it's not always that we want to make these political decisions or we want these political implications, but they come with a mandate that's been given to us. And certain decisions that have not been made at a level higher up between the Commission and the Council and the Parliament by the people that have actually been elected, because they can't agree. And then they phrase something that can be interpreted in various ways. And then we are left up to interpret it in a way that resolves the conflict. And then, of course, we are sometimes in the middle of a debate and a storm that actually we have no interest in and we would rather avoid. But that's our job, given to us.
Yes, thank you. Thank you very much for your frank answer on this point. That was very useful to complete the discussion we had this morning, because it's clear that this multi-stage system of rules in Europe, when we have the big picture of the legal system, the legal architecture, not so complete because we still not have a federation in Europe. There are some missing points, and we should live with this. Thank you very much for
my pleasure. Thank you
for your presentation, and then we can introduce the second speaker of the afternoon, Professor Marta Bosina, that is professor at the Faculty of Economics at University of Pula, where she teaches European Monetary Union law and governance. So the best person to continue this discussion. And the topic she will present will be PSD2 versus MiCAR. So how to let two pieces of the big picture of the legal system to converge, or if they diverge. Professor Bosina will tell us. Professor Bosina, the floor is yours.
Thank you. Good afternoon to everyone. First of all, I hope you can hear me in the room. If I can, perfect. And if I can ask for some assistance in sharing the presentation on screen, this was the main issue that we had before. So I don't know if it's Perfect. I can see the presentation. So first, I wish to apologize for not being able to join you in person at this really excellent conference organized by the Roma 3 University. I've been following the discussion from this morning, and I warmly thank Professoressa Paglietti and Professoressa Bresciamorra, also our panel chair, not only for the very kind invitation, but also for the smooth transition from an in-person participation to a remote one in the last minute. So as you can see from the title slide, my presentation today discusses the relationship between the second Payment Services Directive and the Markets in Crypto Assets Regulation. And I wish to be normatively precise, although it has been quite some years now that I have left the law faculty as a student, and now I teach mainly to economic students, but I wish to be normatively precise and say that I refer to the proposal for a regulation of markets in crypto assets that should be approved by the European Parliament any day now, actually. And the main motivation for this discussion is to provide an evolutionary perspective on how technological and market changes in payment markets have been complemented by growing regulatory productivity in payments, which I think aided the digital transformation in this domain. And then also to reflect on how the new iteration of the PSD regime could streamline regulation in this area, given the rising complexity of payments regulation that we are witnessing. So right away, I would like to say that in my opinion, the PSD2 and the MiCAR are not very different kinds of animals. So I don't consider them to be in opposition, in fact, regardless of the proposition versus in the title of my presentation. In fact, both instruments, I think, have a central position in the legislative framework for payments and therefore financial services more broadly. The PSD2 is placed at the heart of the open banking regime, and the MiCAR is central to the digital finance package of the Commission. And I also think when, at first glance, they have this comparable pro-competitive market effect, as they both open EU payments to new service providers. And in my opinion, MiCAR actually pushes the PSD regime to investigate new payment formats. And lastly, if you look at the two pieces of legislation, both instruments speak to the consumer, so to say, because they do offer enhanced or tailored protection measures. So please, the next slide, if you can, thank you. So to summarize the structure of my presentation, I will begin by providing some contextual background to the PSD2 and the MiCAR. I would like to first reference the panel's topic, which is the implications of financial and digital asymmetries on payments. And I will then address the PSD2 with the goal of explaining how this directive revolutionized payments, both for market actors and end users. And I will try to assess the PSD2 relevance in light of market developments and mark some open questions that stem from this progress. Then I would like to turn the focus to the MiCAR, the EU's first legislative attempt to deal with disruptive technologies embedded into financial assets. This is a regulation that clearly wishes to capitalize on crypto assets. And here I will reflect on the main touch points between the MiCAR and the PSD2. And there, in conclusion, after a brief recount of where EU legislation has been, so to say, after identifying concerns within the current PSD2 framework, in the context of the MiCAR, I would like to tie the threads together and provide some concluding thoughts on how the MiCAR is likely to shape also the progress towards a new iteration of the PSD. So next slide, please. So let me first map asymmetries and briefly discuss their implications. In 2023, I think it is cliche to say that technological innovation, first of all, digitalization, cloud storage, or distributed ledger technologies, so DLTs, are the main drivers of payment solutions, and they add great value to consumers and businesses alike. But at the same time, it is not cliche to emphasize that digital payments operate in a constant state of heightened riskiness. And exploring the nature of this riskiness, I would first say that in the financial system, we are familiar with the concept of asymmetries, such as the use of proprietary information by traditional market players, most notably banks. And we are also used to the externalities that result from this information knowledge and at times misuse. And this is the typical economic understanding of asymmetries, which has been extensively analyzed over the years within the scholarship focusing on the agent-principal relationship. And so we can call these known asymmetries. However, fintech businesses can amplify externalities of the known asymmetries, as well as usher in unknown asymmetries, new asymmetries, which are results of the disruptive technologies being co-opted in payments. So, for instance, the entry of new market players, service providers, execution processes in payments, and so on. On the one hand, fintech can close information gaps because of the vast amounts of data they manage, or thanks to the direct linking between investors and borrowers. But at the same time, conceptual ambiguities associated with the types of products, for example, e-money tokens and their potential treatment as funds, or outright regulatory gaps, such as issues of consumer protection surrounding crypto asset service providers, which I will later touch upon, mean that fintech presents risk for either the consumer of fintech products and services or the market itself. So this is the sense in which I understand the term asymmetry for the purposes of my discussion. And I needed to do that because I needed to somehow bring my discussion on the interplay between the PSD2 and the MiCAR in the context of the panel's topic. So in light of the potential increased use of, for example, crypto assets as payment methods, any legislative measure has to first identify new asymmetries and provide a balanced regulatory answer. A balanced answer means that it is something very elusive. It is difficult to point out, but it means that regulation cannot stifle innovation, but at the same time, it has to future-proof traditional incumbents against disruptions across the value chain or within the payments market in general. And really, if you look at the PSD2 and the MiCAR, they both address different types of asymmetries. They both harness different types of asymmetries depending on the stage of market development at which they were introduced. So the next slide, please. In the payments domain, I think that the PSD2 is the single most important legislative measure that was critical for the technological revolution in payments, both in terms of market growth, expansion of industry actors, the increase of consumer benefits. We have heard just recently, a minute ago, about the many benefits of the PSD2. So the overarching goal of the PSD2 was not only to respond to the profound changes going on in payments, but also actually to leverage or capitalize on the use of third parties in the broader execution of a payment transaction. Now, which asymmetries did the PSD2 harness? So the first asymmetry that needed to be addressed were new market entrants in payments. So the emergence of actors that offered consumer or business-oriented payment services based on payment account information. And here the European Commission decided to extend the concept of payment service provider by introducing the TPPs, or the third-party providers, with two different subcategories that we are familiar with: the payment initiation service providers and account information service providers. And these existed and exist alongside traditional incumbents such as banks or card networks. Basically, many of these are fintech companies operating exclusively in the area of payments, and therefore they are commonly also referred to as paytech. At the same time, the PSD2 introduced a standardized application programming interface, or API, in order to safe-proof the sharing of account information between the banks and TPPs, or paytech in general. APIs were really crucial to tackle the issue of misuse of consumer data and ensure that the PSD2 banned at least traditional screen scraping methods. Also an important asymmetry, but perhaps this is less relevant for the discussion that I am presenting today, so the interplay between the PSD2 and the MiCAR. And lastly, the directive also introduced strong customer identification that tackled the riskiness of online payments, making the unbundling of banking and the online payments more appetizing for the consumer. And the extension of the regulatory remit to paytech had a twofold scope. So the first one was to, of course, create a level playing field for all payment service providers, resulting in greater competition. So this is the pro-competitive character of the PSD2. And the second, to increase payment safety for consumers when unbundling the banking business. So to actually aid this technological revolution. So the next slide, please. So how successful was the PSD2 as a legislative measure in kickstarting the revolution in payments? And if you look at the relevant literature, reading it, the success of the PSD2 is at times contested, with arguments of a chicken or egg situation, because some of the actors and services addressed by the PSD2 existed prior to its enactment, and therefore this directive can be considered also as an imposed innovation measure. Regardless of that, most can probably agree that without the PSD2, the open banking ecosystem would not have materialized. As I said, it would not have been that appetizing for consumers. And we would not have had such a surge in new market players or TPPs in payments to the benefit of end users. And indeed, if you look at statistics, and I've given just two very simple statistical examples, for example, of figure 1, that the number of TPPs registered as paytech companies has grown exponentially since the introduction of the PSD2, with API transaction calls reaching over 2 billion by December 2021. And we can see from figure 2 that the majority of TPPs is interested in account aggregation services, especially in very mature fintech markets. These are, of course, Sweden and the Netherlands. Also, I think what the data shows us is that the PSD2 was a successful pro-competitive consumer safeguarding legislative measure, regardless of the debates about the innovativeness of the directive, and also irrespective of some structural inefficiencies that emerged later on during the directive's implementation and enforcement, and were mainly related to the use of APIs by TPPs. At the same time, the PSD2, and this is very important also for the progress of my discussion toward MiCAR, recalibrated the regulatory paradigm in payments, with the Commission opting for leveraging on market development. So it introduced new levels of customer authentication, regulatory reporting, so on. Overall, it demonstrated that EU financial services legislation can engage with markets and financial innovation, make it more safe, more reliable, which of course is a key feature for end users and in this highly digitalized landscape. Next slide, please. Of course, markets and payments continue to evolve over the process of PSD2 implementation, and so some new asymmetries emerged primarily related to the introduction of crypto assets in payments. We have heard this morning a splendid recount of the evolution of money and its many formats, but by crypto assets, just to briefly recall, crypto assets are assets that depend on cryptography and DLT, which are not issued or guaranteed by a public authority and can be used as payment tokens, such as, for instance, cryptocurrencies, for example, Bitcoin, for investment purposes, such as Banquera, or to access goods and services within a specific cloud services platform. And if the role of unregulated crypto assets in payments becomes more common in the future, or if they become more interconnected with regulated payment service providers, how will this affect EU payments and, more importantly, the PSD2 and EU financial services legislation in general? Well, currently, the EU legislative framework for financial services provides rules with, I would say, indirect relevance for crypto assets, such as the MiFID II regime that governs crypto assets considered financial instruments for the purposes noted in Article 4.15 of the MiFID II directive, the fifth anti-money laundering directive, which governs virtual currencies and specific types of virtual asset service providers. And finally, we have the second electronic money directive and the PSD2. And the last two acts in particular require a much closer and coherent coordination with the Commission's policy initiatives and legislative proposals in its package of digital, in its digital finance package, because the main intent is to actually work in synergy with existing legislation in the market and address crypto assets that currently fall outside the EU's regulatory remit. So the next slide, please, and going toward the MiCAR. The MiCAR is one of the central pillars of the Commission's digital finance package, and together with the DORA, so the Digital Operational Resilience Act, this is instrument that provides a legal framework for crypto assets, as well as crypto asset issuers and crypto asset service providers, or CACPs, that operate in the EU. And whereas with the PSD2, I have said that it was seen as an imposed innovation measure, MiCAR has been nicknamed by many as an innovation-friendly measure. And although it covers issues outside the PSD2 scope, MiCAR's objectives are comparable to those of the PSD2 when you start to look the broader picture of the two legislative acts. So first, like the PSD2, that sought to provide a legal basis for new players in the payment market, allowing new means of payment to reach the broader market, as stated in the recital of the PSD2, the MiCAR also seeks to provide a legal framework for the use of transformative technologies in the financial sector. Then, like the PSD2, also again stated in the recital of the directive, the MiCAR promotes innovation and fair competition. And then, following into PSD2 footsteps, the MiCAR wishes to improve investor and consumer protection. There are many interesting aspects of this regulatory proposal we're discussing. However, I will limit my comments to the intersection between the MiCAR and the PSD2. And in this respect, it can be argued that the PSD2 and MiCAR have only marginal overlaps. Namely, they intersect first in considering the legal definition of funds, and second, in considering the legislative treatment of CACPs or crypto asset service providers. So let me begin with funds. In its 2019 report on cryptos, the European Banking Authority reported that in the market, new formats of crypto assets emerged, which may fall under the definition of e-money in the sense of the 2009 EMD regime. And as such, under the definition of funds, as provided by Article 4.2 of the PSD2. So going on to the next slide, where I continue on this interplay, such formats of crypto assets must be electronically stored, have monetary value, represent a claim on the issuer, are issued upon the receipt of funds, and are issued to make payment transactions in the sense of Article 4 of the PSD2, so as placing, transferring, and withdrawing funds, and have to be accepted by persons other than the issuer. Although, at first glance, it appears that the PSD2 excludes any type of crypto assets from its definition of funds. If a firm is carrying out payment services with a crypto asset that qualifies as e-money using DLT, for instance, the execution of a payment transaction, such activity would fall within the scope of the PSD2 by virtue of being funds, and this has been noted both in the literature and also in the report of the European Commission and the EBA on the proposal on the MiCAR, and also on its study on the impact of the PSD2. As a result, with the current EU legislation, we have this ambiguous definition of crypto assets as funds that definitely requires streamlining, especially if we consider the potential of crypto assets being used as a means of payment. And this is not unlikely because MiCAR establishes two types of tokens that might appeal to consumers. So asset reference tokens, ARTs, and e-money tokens, EMTs. And the prospects of these tokens being used as means of payment will depend on how successful their stabilization mechanisms will be. And here I am referring to a recent work of one of the panelists today. I think that looking ahead to the PSD3, perhaps it would indeed be prudent to extend the PSD2 definition of funds, at least to include e-money tokens, which in practice mirror e-money. The second touch point between the MiCAR and the PSD2 is a CACP, which offers payment services as part of its crypto asset portfolio. The issue here is primarily the disparity in consumer protection levels between the PSD2 and the MiCAR. Specifically, if a CACP contracts with a payee to accept crypto assets other than e-money tokens, it should follow the same requirements on consumer and operational resilience and so on as those provided by the PSD2 for a payment service provider. So maybe the CACP should be authorized under the PSD2 regime. Or alternatively, there is also the idea that considering that the MiCAR provides less consumer protections in comparison to the PSD2, a payment service provider authorized under the PSD2 regime should be appointed as a CACP. Lastly, in view of maximizing the coherence between of the PSD2 and between the two legal acts, the Commission notes that it should be clarified if a CACP activities can be defined as the acquiring of payment transactions within the meaning of the PSD2 directive. So going to the last slide. So thank you. The PSD2 was a bold step for the EU. I think we've heard that also from the EBA. Policymakers decided to be a part of the change, proactively guiding and assuring European consumers as they navigate technological innovation. And with the advent of cryptocurrencies, which threatened to break the link between money and state or the public authority, that we have talked about this throughout the morning, or even to redefine money as something that can function outside of legal frameworks, the EU has decided instead to capitalize on unregulated cryptos by proposing the MiCAR as a central legislative pillar of its digital transformation strategy. I think MiCAR has a great potential to regulate the crypto assets ecosystem and to transform radically the landscape of crypto assets that we now know, making them more appealing for consumers, or at least, again, to put my economic hat on, for risk neutral or risk seeking consumers. However, at this point, of course, it is impossible to predict MiCAR's full impact on the market and consumers. Will it be comparable to that of the PSD2? But although the PSD2 and the MiCAR intersect at few points, the Commission acknowledges the need for a closer interplay between the two acts. So from a lege ferenda perspective, the PSD3 should be an opportunity to consolidate the PSD regime with the MiCAR, as well as with other legislative instruments relevant to MiCAR scope. First of all, the EMD2. An example of this would be the recalibration of the definition of funds to include at least some format of payment tokens, such as e-money tokens. But there are also additional outstanding issues, such as those concerning consumer protection, that are very critical and interesting to look at. And at this point, we can say that once the MiCAR is adopted, a revision of the PSD2 will be essential to streamline the regulatory framework for payments and maintain regulatory coherence in this domain. But I think that a recalibration is nothing to be nervous about. In fact, the regulator has prompted one in the PSD2 when the current degree of innovation leads to the rapid emergence of new payment channels. So the recital goes. So in that sense, the introduction of payment tokens, as well as the prospect of central bank digital currencies, also a very relevant topic that we've touched upon this morning, and another intriguing payment development. They both mark an inflection point for the PSD2 and the PSD regime in general. So thank you, and I look forward to hearing the other presentations and also to the discussion afterwards. Thank you.
Thank you very much, Professor Bosina, for your very interesting presentation. And for the last remark, probably, if I correctly understand, the PSD3 could be a bridge to complete the picture of MiCAR. MiCAR, this is my personal idea, is not a milestone in the regulation of cryptocurrencies. It's a first attempt to try to understand. It's a learning process, also way to regulate that is needed when we are trying to follow up financial innovation and technological innovation, because we are trying to first understand. So probably PSD3 could be of help in order to complete even the MiCAR first step in regulating cryptocurrencies. That is a different word, because we are speaking about, in both cases, probably we are speaking about money. Cryptocurrencies cannot be qualified always as money. Could be qualified also as financial products as well. But payments and money are two different concepts. This morning, many times we have used replacing one word with the other one, and probably we should fix better the idea. Thank you very much. To this end, your presentation was very useful at least to understand the problems we have in front of us. Now, I'm very pleased to give the floor to my dear colleague at Roma 3 University Department of Law, Alberto Pozzolo, who is an economist, and he will speak about open banking, pitfalls and opportunities. Yes, also on this point, the open banking, we started to have the first experiences, and probably figures could help to understand the state of art. Thank you very much. The floor is yours, Alberto.
So thank you for being here, and thank you especially to the organizers for inviting me to this conference that I found extremely interesting. I'm in a very good position because I'm an economist, so if I say something wrong about economics, many of you won't spot it, and if I say something wrong about law, I mean, it's not my field, so you may understand me. This is joint work with Giorgio Barona-Varretti and Giacomo Calzolari. I will have a spot at the end. I mean, it's a work that we are carrying on within a journal that we are publishing, but I will finish on that. So I thought that I had to explain why I wanted to talk about open banking in a conference on payment services, but then I noticed that many people before me explained it very well why this is there is a link, a very strong and important link, so I'll skip that part. The plan of my presentation is first of all to start talking about what is open banking. I mean, we had some definitions. I want to give my view, the view of an economist, and then I will focus on what is the good that is at the base of open banking. Economists are normally used to think about trading goods. I want to say what is the good from our perspective that is traded, which will help me to explain better what might be the outcomes of a possible open banking evolution or open banking revolution. And then I close with some views on what may be the impact also in relation with what were the purposes of PSD2 initially, and what may be the risks. And on this I will be very close to what Professor Zenozenkovic said earlier on. We mostly agree. It's only on minor subtle issues that we have disagreements. So what is open banking? This is a definition that, as you can see, comes from a journal Computer. These two guys are two engineers, and they define open banking as a special kind of financial ecosystem governed by certain security profiles, application interfaces, the APIs that we've heard already, guidelines, and this ecosystem should have the objective of improving customer choices and experiences. This is not even an economist's view. This is the view of engineers and computer scientists. Now, why is this relevant? So to understand the impact that open banking may have, I think it's important to take one step back and understand how the traditional banking relationships, those before they became open, worked. So if you think about the traditional banking system, if you want to connect customer A with customer B, well, leaving aside the special case in which we make payments using banknotes, but we already heard this morning that this is really a special case in terms of the share of total payments that we make. The banking relationships imply that you had to go through a bank. So a payment had to go through a bank. This built a relationship. So essentially, the bank, through these payments, managed to acquire a lot of information that becomes extremely important. these banking relationships produce information, and this information is typically valuable for the bank. There is a large literature in economics that studies what is the advantage for a bank of being at the same time the place where you put your money, so you have your current account, and the institution that give out loans. And this literature has come out with strong empirical evidence showing that payment information are used by banks to assess the credit scoring, the credit capacity of customers. If you are a firm and your bank sees if actually inflow payments are coming in, well, the bank realizes that the activities are going well and so on and so forth, so they may be in a better position to grant you a loan. This might seem to be not particularly important, but in the end, in the banking business, turns out to be extremely important. Who owns this information? I mean, this information is produced by the very fact that you go through a bank to make a payment. So the information is produced by the transaction. It is actually owned by the bank. We normally have some problems to collect all this information about our specific payments. Well, nowadays it can be easier, but think about the different value that having all the information stored within a bank and also possibly compare information across different customers. And what you can prove if you go to another bank and you show your credit records, you show your balance sheet payments, and you say, you see, I've got a good evolution of my business, payments are coming in, I don't pay too much for my inputs and so on and so forth. I mean, being able to use all this information that is produced is extremely important for the bank. Now, our point of view is that the good traded in open banking is precisely information. So open banking is about opening up the access to this information that otherwise is captive in a bilateral relationship between the bank and the customer. Information is a very specific type of good. It's what we call a semi-public good because it is partially excludable. So the bank, if it wants, can cut you off the access to this information. But it is non-rival, which means that if I have access to that information, you can also have access to that information, and there is no clear loss of value if we both use and can have access to that information. So open banking, by making access to this information on payments to all third-party providers that might be interested, aims at creating a market for these customers' data. And originally, it's only on payments data. This is what the PSD2 requires. But we have heard that we can have open finance, and with open finance, indeed, we could also increase the amount of information that is made available to additional parties. How can this information be transferred? This is not a minor issue. I mean, we had Dr. Halbrick mentioning before the issue of standardization, and the way in which this information is transferred is by using these application programming interfaces that allow automatically to enter the computing systems of banks and extract the information that you want to use. Of course, as long as the customers that are seen as the true owners of that information allow you to do that. But technology matters quite a lot, and I honestly, and we actually think, me and my co-authors, that this can be a problem probably bigger than what has been uncovered so far, because these technical standards can be really a barrier to entry for a number of external parties. I don't know, here I shouldn't probably use terminology that is not my own terminology, but I see within this framework the ability to access this information from a technological perspective as an essential facility in the kind of definition that has been given this morning by Professor Sarmiento. Well, on this, coming back to what Dr. Haubrich said, honestly, I have the impression that a bit of a stronger approach by authorities would be helpful in order to avoid excessive heterogeneity in the kinds of protocols that can be used. Let's just think about the problem of cell phone battery charges and the fact that we went through years when we had 10 different battery chargers. Then eventually legislation came in, and I think we're all happy of that. And in the technological world, there are many examples like this. Probably a bit of a tougher approach would be good. Now, the question at this point is, where did open banking originate from? And the kickstart of open banking comes from regulation. It's not something that came out from the market. I mean, we economists normally like very much to think that everything comes out of the market. There was not a market for information of this kind before regulation created that market. In Europe, it was indeed the PSD2 that started it, requiring financial institutions to open up their data to account service information providers, payment initiation service providers, and card-based payment instrument issuers. I mean, the third group doesn't seem to be that relevant. The second group at the beginning seemed to be the one that actually enhanced competition the most, because the idea was that it was in payment services that there was not enough competition. What seems to be true now is that these account service information providers are becoming more important because it's them that collect information and make it available to potential third parties. So the idea is that, for example, you can allow a third party to access the information about all your payments and then go to a third party that can be another bank and ask a loan to that bank. And that bank is in the same position with respect to the information it has on your transactions as the bank that has actually carried on your transaction. And this, of course, increases competition substantially. Now, the role, the rationale of this open banking was of enhancing competition, favoring financial inclusion, and fostering innovation. The model that the model that come out is something that I will show you in a moment. The question is this regulation enough to achieve the goals that we wanted? I mean, open banking is about transferring information to third parties, and the impact of open banking will depend on how this information will be spread and how it will be used. Let's think about the two parties that are involved. On the supply side, you have customers, and customers are likely to open information to a small number of counterparts of their choice. I mean, I have problems to think about that as a customer, we will open up the information about our current account to everybody that asks for it. You will open up to those that you think can use that information to provide you with a service that otherwise you would have at worse condition, probably at more expensive conditions. So this will make the market for this information smaller than what you can originally think. On the demand side, what are the third parties that will enter and actually access that information? We may think that these parties will be those that somehow will make money out of the information that they get. I mean, it's true that access needs to be free of charge, but you need some technological infrastructure in order to access that information. You need to spend money out of it. So you do it if you think that there is a profit prospect out of this activity, which implies that not everybody will actually come into this this market. I have a mess in the way in which I have stapled my notes. So let's forget about that. So let's think about the impact. On the one hand, we can think that, as I made the example a moment ago, you open up your information to an additional bank. The additional bank is going to offer you a loan at better condition. So this improves welfare for everybody. So open banking is beneficial. But you can think about a completely different scenario where these data are made available to a platform. So a new financial provider emerges, and this financial provider has as a business model that of collecting information from the demand side and from the supply side and matching that information in order to provide the best services to the clients that wanted to have those specific services. This is the typical activity of a platform. If you want to think about a platform that we all know about, Amazon is a typical platform. We know Amazon from the perspective of consumers. We know that we look for something that is difficult to find. Amazon is a good place to start because they offer nearly everything. But this is true also on the other side. If you want to sell something, where do you go? If you are a small firm, where do you go? You go to Amazon. Well, the point is that you are creating at this point a situation where you have customers on one side, this platform in the middle, and the financial services providers on the other side. And you can think that these financial services providers are many different financial services providers. So you can have somebody that is providing current accounts, somebody providing mortgages, somebody providing other services. But where is the value of the information at this place collected and stored, and who actually can gain value from having this information? It is the platform itself. You are making all the providers competing with each other, but it's the platform that manages the information. And we said that the information is the good that is traded. It is the one that allows you to make profit. So the platform in this two-sided market has the technology to match the different clients, and most likely it is the only one that can manage all that information. Managing information means not only having the information about the single user, it means comparing information across hundreds of thousands, millions of users. So at that point, we have reduced the monopoly power of the bank because we have severed the lending relationship between the bank and the customer. And there is the possibility that we have given this power of dealing with the information and of managing information to a platform. Which are the platforms that may emerge in this situation? So if you think about the market for goods, I made the example of Amazon, and indeed, I mean, Amazon is not a perfect example of competition. In the case of banking, we've been discussing a lot. We don't have a shared view, me and my co-authors, on this. But in the case of banking, you already have very large players that can become platforms. But it is unlikely that it's going to be a small bank that become a platform. It's going to be a large bank that already has a lot of information, has the power to manage that information, and eventually can further increase its size and increase its monopoly power. So this is a great challenge. Because within these platforms, you can typically have problems of network externalities, and network externalities give rise to huge economies of scale. So the reason why there are mainly 2 credit card systems in the world is precisely because you have economies of scale. If you start the third one, no shop is using it, so there is no incentive for you to use a new credit card. And the shop has no incentives to accept it because there are no customers using that credit card. So you are cut off that market. In addition to that, there is evidence that there is a lot of vertical integration in these cases. So the bank or the platform can also integrate with some of the service providers. So will regulation help in this situation? Well, the long-run effects of open banking are indeed challenging, difficult to predict. We don't even know whether this platform model will emerge, even if some literature is saying that it is likely. What certainly is extremely important under our point of view is that regulation be proactive. I mean, regulation managed to start this open banking business. Regulation needs to take into consideration what are the possible different scenarios that may emerge. And I'm very happy to hear that these things are already being considered. PSD3 is going in this direction. This statement that you see here about the fact that legislation arrived a bit late in the case of Digital Market Act and Digital Service Act is something that I've taken from my my co-author Giacomo Calzolari, who's an expert on this. Indeed, he convinced us that in that case, the regulation has arrived a bit too late. And I close with the advertising. This is actually the editorial of the next issue of our journal that I'm co-editing with Giacomo and Giorgio. It's a free access journal. You can access it at from the website you see below, and the issue will be presented next week in Bruegel in Brussels. So thank you for your attention and also for actually accepting this small advertisement.
Thank you very much, Alberto. Yes, before your presentation, on the basis of the figures that in Italy we have about customers have allowed open banking on their bank accounts, I was thinking this topic was not so relevant because they are very few, the people, the customers of banks that currently have used this prerogative established by the PSD2, but I was trying to check which is the English translation when the going gets tough, the tough talkers sit on the hands, or of this expression. Probably the issue will become relevant when the big techs enter into the game, come into play, because of course this will change the scenario, I guess. If they will use this open banking right to for their own purposes, and they are really giants. They are monopolists of information, and this could be effectively dangerous. And this is the problem you very clearly highlighted to us. Now, another issue very important that was touched upon this morning by Maria Cecilia, and now we will go on this point with the help of Gabriella Gimigliano. Gabriella Gimigliano is a professor at Siena University, I remember well, because we met many years ago when we were younger. She is an expert in this field of payment services, and she will give us a speech on vulnerable versus not vulnerable payment service consumer. Thank you very much. The floor is yours.
Thank you so much. Thank you so much for inviting me today here. I want to thank Professor Chamorro, Professor Paglietti, and I'm going to there was a great discussion, and so extremely helpful.
Excuse me, sorry for interrupting. We are unable to hear you. Can you maybe speak closer to the microphone, or maybe the microphone is not switched on, but it's not possible to follow you. Sorry for that.
Can you hear me now?
Yes, much better. Thank you.
Thank you. So, even because today, especially Cecilia, who gave me this topic in June, told me, asked me to change my mind and to try to study the provision of payment services, taking the standpoint of the consumer, especially the vulnerable consumer. I must tell you that I'm still at the beginning of this study, but I found it extremely interesting. And let's begin with the three basic, the concept, the guideline of my research. First of all, the concept of consumer. We are all familiar with the concept of consumer. The concept of payment services, which was mentioned many times today in the morning, in the afternoon. There is no definition of payment service. There is a concept that we can infer from the establishing a link from the connection between the Article 4 and of the Payment Service Directive and the annex to the Payment Service Directive. So the concept of payment services comprises any transfer of funds and data, generally speaking. So any the execution of any payment transaction in terms of placing funds, withdrawing funds, or transferring funds, and the transfer of transaction data. So the data which was talking about the previous colleague. And now, who are the vulnerable consumers? Does the PSD2, that's the PSD2 mention vulnerable consumer? It doesn't. Well, I've not found it in a mention of vulnerable consumer in PSD2. But there is an indirect mention of if we go beyond the PSD2 and we look at the framework for payment services, we find that the concept of vulnerable consumer is in two directives. The Unfair Commercial Practice Directive, which is mentioned in PSD2, and the European policymaker asked us to establish, provided that it must be applied to the payment services transaction, and the 2014 Payment Account Directive. Let's begin with the first one shortly. In different commercial practice directive, so the concept, there might be in unfair commercial practice as far as there are any omission or behavior conduct which is likely to distort the economic behavior and which is contrary to the professional diligence. What is the point? The point is that it may influence, it may alter the capacity of the consumer of making a transaction which is it may influence his or her economic behavior in such a way that the consumer made the transaction or did not make a transaction if this practice was not present. What was the point? As for the vulnerable consumer, were certain characteristics such as age, physical or mental infirmity or credulity make consumers particularly susceptible to a commercial practice. What's the point? So the point is that we have here group or categories of consumers, and according the traders should organize themselves in such a way to take into account that they may be more easily influenced, and so they may the trader and with their commercial practice may more easily alter the capacity of this the economic capacity these categories, consumer categories. So there is no compensation remedy. There is a conduct rule imposed on the traders. So the traders have to organize themselves in such a way to achieve this object, this policy priority. And I think this is important. So what changes is the business organization first, as a first point. Let's see with the second, the PAD directive, the 2014 Payment Account Directive. The Payment Account Directive covers several aspects. Among these aspects, also the payment account with basic feature. So according to the Payment Account Directive, Article 16, I think, all consumers are entitled to hold a payment account, at least a payment account with basic feature. And no discrimination is allowed on the ground of nationality, residency, and so on. But all payment service providers are bound to provide this service, not all, only credit institutions. And not all credit institutions, only the member states are in charge of picking out the credit institution in charge of providing this service. Now, the directive established the contents of these services. So what type of services the payment account must provide, must cover. It cannot be only an online account. It must, the payment account with basic feature allows the holder to transfer and receive some money by means of credit transfer, direct debits, credit card, but there is no right to overdraft. No, this goes beyond the scope of the directive. And when the credit institution can refuse, are entitled to refuse the payment account only for, it seems, only for general interest. For example, if the applicant already has a payment account somewhere, if the applicant did not was found guilty of money laundering, if the account was suspicious or something, some other criminal action, or because, and this is something strange, he has no link with the territory, no concrete connection, no interest. It's, if I remember correctly, no interest in the territory. So these are the three possible justifications for refusing the opening of a payment account with basic feature. So what is if the consumer, the applicant, is a vulnerable consumer? It depends on his economic background. So the charges, the fees for the payment account will be based according to its economic financial background. So here we have a different meaning of vulnerability. There we had a vulnerability in terms of something which may influence your capacity. Here we have vulnerability in terms of economic background, financial background. Indeed, for example, anyone can apply, not only the nationals of the member states, anyone, for example, anyone who is legally resident in the union. Now, what are the first conclusion that we may draw on this comparison. First of all, that the European policymaker in the PSD2, but also in the PSD1, were made a clear-cut choice. So they made a choice of not mentioning vulnerability with awareness, because they are familiar with this concept, not only in also in the financial sector. And the second point was that both directive that accommodates to different meaning of vulnerability takes a comparable approach. So both of them impose on the traders or on the credit institution a type of business organization. They lay down a conduct rule, which is going to influence the business organization. So, should we conclude that nothing can be done in PSD3, so we should set aside the idea of a vulnerable payment service consumer? Well, I don't think so. First of all, because money is not a neutral. I believe that it is not a neutral instrument, a device, but according to as Mary Mello wrote in 2019, it is a something which helps a person to participate to a society. So we cannot go just limit our analysis to money as in its market function, but money establishes comparative values in a range of circumstances, social, political, and economic. So money is a means of a community belonging, and it should be regulated as such. And indeed, Christine Desan, she, as you can read by yourself, but what is the substantive value captured by $1? One that convinces people with different needs and means to understand it as a common measure. So what can feed trust in money? Here, Desan is mentioning currency, money in terms of unit account and reserve of value in terms of currency. But according to, so we might go straightly to monetary policy. But as the European Court of Justice told us in January 2021, the monetary policy is not just does not have just a technical meaning. It also has closely connected to the way of discharging monetary obligations. We should, and the Court of Justice prompted the national judge to keep this into account, that the approach of to the legal framework for discharging monetary obligation may influence the way what we consider as money. If we cannot think that if some member states consider money just banknotes and coins, and some other scriptural money is without consequences. So we should have a common, a similar approach. And according to the Court of Justice, it should be a balance between banknotes and coins and scriptural money. And this is, so this second point brings us to another step. We cannot exclude, we need to make an effort to consider how to reach how to understand who are the vulnerable consumer and how to involve them. It is in the PID directive and the Unfair Commercial Practice Directive are not enough. We should think about what the vulnerability within the PSD2 or PSD3 rationale. And we should try to understand the aim and to tailor-make this concept to the rationale. So the rationale of PSD2 was to improve competition, to set a full automated straight payment transaction. Yes, because we are the PSD2 was the last step towards moving all payment online and supporting the proper functioning of the internal market for goods, for services, for financial product and so on. So this was the aim, and this was the rationale. So it took a pro-competitive approach. We cannot think, okay, let's set aside the approach and try to create something completely completely new and not consistent with this aim. A completely new vulnerable consumer concept that does not take into account this rationale, this aim. We can't. So for this reason, maybe we could begin analyzing what was. I think I ran out of time. Okay, so I taking into account the rationale of PSD2 and payment service directive, you should try to consider who are the vulnerable, the consumer not familiar with the level of ability which is required to a average payment service consumer. They might only the elderly people, maybe not. It depends. It is the technological gap is not closely connected to the age. It is something cultural. Also young people may be not very familiar with technological development. So we might consider the possibility of analyzing, assessing, or ask the payment service provider to assess, to evaluate the ability, and according to a dynamic approach, which was mentioned in the morning, and in order to assess how it evolves. And I believe that the PAD, this is extremely important because it does not make the difference between according to the age or the cultural, the educational background. It depends on the cultural climate, and it might become a conduct law rule for the payment service provider. And according to this conduct law rule, the payment service provider should set up a consistent organization, a consistent business organization. And in this way, just remember what Mr. The first speaker who was told us. Thank you. Sorry. Told us the banks can no longer establish just an application, a mobile app for carry on some basic cooperation, but they should be try to check who is the customer, who is the consumer, what type of ability he or she has, and how this ability develops, especially because according if we analyze more in detail the PAD, maybe we can understand that the payment service, the provision of payment account with basic service is with basic feature is a service of a general economic interest. And as far as it is a service of general economic interest, this might become a policy priority. Sorry for the delay. Thank you.
Thank you very much, Gabriella. Yes, we have discussed with you again the point which are the main goals of the underlying the PSD are only to get an efficient service payment market, or there is more. And in particular, and also this is and equal opportunity rule is not expressed, as you have underlined, is not expressly called in the direct, yes, in the PSD2, and this again is a matter of political choices that could be discussed, and we heard from the EBA that EBA pays attention to this point, no? Pays attention to this point, and we are happy of this. But it's difficult to establish which are the customers affected. You underlined that the criteria of the age is not the only one. Probably it's a problem of education. Is it this goal a goal of sectorial regulation, or we should achieve these other goals with other instruments other than regulating financial providers services. This could be debated.
It might be. Anyway, we should ask we might ask the provider to organize themselves in such a way to make the difference, not in a static way, but in a dynamic way.
Yes, we will see. Also, the project of central bank digital currencies, to some extent, the idea behind is also to offer to vulnerable customers the possibility of a means of payment that, of course, is still electronic, but comes from a central bank, so then could be a possible option to protect consumers as well. So one of the goals of the central bank digital currency too is the idea to protect in another way vulnerable clients. Thank you very much for your presentation. Unfortunately, Professor Hans Meeking, whose presentation was expected by all of us because we know that he is really a great expert in this field and is a prominent professor of law. Unfortunately, he told us that this night he didn't feel very well, and so he cannot connect with us as he promised. Then we will move to Professor Stephen Boet, University of Leuven. I don't know if I pronounced it correctly. No, not. Sorry, may you tell me? Good. Sorry. I'm very sorry. I apologize for this. I realized that I made a mistake, but we are happy in any case, although my mistake, to hear from you your presentation regarding improving the consistent application of PSD across member states, public and private enforcement of the European Union law of payments. So we are back to a topic debated this morning and that we consider crucial to build this effective regulatory system for payment services. Thank you very much for your presentation. The floor is yours.
Thank you, but I think I first have to send my presentation to the computer.
So just few moments of patience, because I received the presentation. So I ask the audience a few minutes of patience. I know that was a hard day, but we hope it was an interesting day in any case.
Okay. Thank you. Thank you so much. First of all, for the very kind invitation to come to Rome. For me, every excuse to come to Rome is good. I'm a little bit, I think, the odd one out. I know nothing about substantive law. I am a proceduralist, so the only thing that interests me is procedure and how to enforce it. As my predecessor in Ghent once said, that procedural law is the soul of the law, l'anima del diritto. I think this is in Italian. So you need that. You need enforcement rules for substantive law. So this is what I will talk about. And I'm very happy that Olga did the presentation this morning, because I will refer to some of the aspects that she has mentioned. First of all, regarding the division between public and private enforcement, I think one of the smartest men of the University of Leuven was Professor Walter van Gerven, who used to be an advocate general also at the Court of Justice. And already in the 70s and the 80s, van Gerven said there is no such thing as a division between public and private enforcement. It simply does not exist. And he later at his life, he was much more strict about that. And he wrote a book in the 70s, and then he rewrote the book, I think, at the beginning of 2000. And he says we have to stop talking about public and private enforcement. We have to talk about a multi-layered framework of regulation, lawmaking, and law application. And I do think that he was right, and I echoed, I've heard some of his ideas also in the presentation this morning when Olga talked about the blurring division between public and private enforcement. Now, we are here together because of the Payment Services Directive, and the Payment Services Directive, of course, has a very robust, interesting system of rules of substantive law, but it also pays attention to what can you do if these rules are not followed, if you are confronted with an enforcement problem. And I think there are some students in the room, and if you study law, you learn if you have a problem, you have to go to court. In some countries, this can take a very long time. I think in Italy, I was in Milan this week, and I spoke to some judges, and I almost fell from my chair when I heard that for some civil cases, you have to wait 2, 3, 4 years. There are also the quick one. Yes, I know. In first instance, because in appeal it was even worse. And I was thinking that Belgium was bad. I actually felt a little bit better, to be honest. But what I mainly will focus on is the collective dimension of these problems. Because, I mean, we heard about consumers, we heard about vulnerable consumers, and all of these problems in the context of financial payments and in the financial sector in general give rise to problems that have a collective dimension. It is not one person who has been confronted with the problem, but it is a group of people who is confronted with the same or similar problems. And that group is a group of unidentifiable and unquantifiable consumers. And in our tradition, we think, okay, those individuals should go to court. But there are other aspects that I would like to mention. And you see on the slide, there are three things that I will talk about very briefly. I will not talk too long. First of all, I mean, is access to courts. Secondly is ADR. And ADR, I think, is important because the Payment Services Directive, I think in Chapter 6, if I'm not mistaken, specifically pays attention to ADR. And finally, public enforcement. And Olga called it a hybrid enforcement. I learned something new again, because for many, many years, I have been talking about a regulatory redress and not about hybrid enforcement. And these, I think, are to conclude today. And in that sense, the circle is a little bit round. I think it's interesting from an enforcement perspective. First of all, what about courts? I think the PSD2 directive refers in many, many articles to the possibility for consumers, customers, not consumers, to go to court. You find them in some of the recitals, and you also find them in some of the articles. I will not mention them, but it is important that this is a first track that the directive offers. What is important, in 2018, and this is Ms. Jourova, who used to be the commissioner, the European Commissioner for Consumer Affairs, in 2018, she proposed her New Deal for consumers. And one of these aspects of the New Deal for consumers was not only to enforce the substantive rights of consumers, but also to facilitate the enforcement, the collective enforcement of these consumer rights. And one aspect of the New Deal for consumers, and again, it was already mentioned this morning, was the Representative Actions Directive, what we call the RAT now, because Representative Actions Directive, it's very long and everybody knows it's the RAT. And the RAT is not something that is completely new, but is something that is a continuation of the Injunctions Directive. The Injunctions Directive of 2009 allows for qualified entities to bring actions for injunctive relief. So if a qualified entity, usually a consumer organization, but these can also be public bodies, sees that a trader, a financial institution, a bank does something wrong, violates the law, then they can go to court and they can ask the court to issue an injunctive order so that the bank stops doing that wrongful behavior. If customers of the bank, financial institutions, consumers suffer damages, it's up to them. Then they have to pursue an individual track or they have to do that collectively. The Representative Actions Directive basically uses the same framework, but adds another layer in the sense that these qualified entities now not only can bring actions for injunctive relief, but they can also bring actions for collective compensatory relief. And what is interesting is that the scope of application of the Representative Action Directive is limited to consumers. This is also not something new. In some member states, for example, in Belgium, our Class Action Act is also limited for consumers. I have said from the beginning that this could be a constitutional problem, because for a victim who falls under the scope of that collective framework, he or she has collective access to justice, while for people who fall outside of the scope, they do not have collective access to justice, they have individual access to justice. Some lawyers picked up that idea, they went to the Constitutional Court in Belgium. The Constitutional Court in Belgium said that I am completely crazy, that this is absolutely no discrimination. But I think that in the future, now a lot of member states are implementing the directive. I do think that this will be challenged in some European countries. And I'm already aware that in some Eastern European countries, this will be the case. But what is interesting is that the scope of the Representative Actions Directive is determined by a list, an annex at the end of the directive, in the sense that if you want to use the Representative Actions procedure, your cause of action needs to be one of the regulations, the directives that you can find in the annex. And, surprise, surprise, what is in the annex? It is the Payment Services Directive, which is one of the instruments that you can invoke. So, in the future, in all of these EU countries, and I think in Italy you already have a class action system, but it's very complicated. And I think there are 2 or 3 systems, and I have read about that many, many times. And to be honest, mea culpa, I still don't really understand it quite well. And I probably never understand it. But in a lot of these countries, the directive needs to be implemented. So if there is a violation of the rules in the Payment Services Directive, then this will give rise to collective actions, to class actions, which in other countries is already the case. We talked about that very briefly, for example, in Canada, where banks are very frequently being hit with class. So these representative actions directive, I just want to mention them. They are composed of a number of building blocks, and at the center you have these qualified entities. What is interesting, and again, this is a beautiful example of that blurring division between public and private enforcement, is that not only private associations, consumer associations, or associations that are defending, for example, the interest of minority shareholders can bring these collective actions, but also public bodies, not individuals. In common law systems, these class action procedures are usually have to be brought by individual class members. There are exceptions, for example, in securities litigation in the US, you have exceptions in the sense that it has to be the class member with the biggest damages, usually pension funds, that have to bring these cases. But here it has to be an association, usually consumer associations, or the directive also allows for SPVs, special purpose vehicles, ad hoc associations, which again in the Netherlands is, I think, most of these cases are being brought by them, but also public bodies. Public bodies. The best example is Denmark. In Denmark, you have a regulator, the consumer ombudsman, who's not an ADR entity, but who is the consumer regulator, who is the only one that can bring a private class action on an opt-out basis in a court. He or she, it used to be a he, now it's a she, never had to use it because the previous ombudsman used to call it his, and maybe this is very sensitive these days to use that term, used it his nuclear bomb. And he said, if a company does something wrong, I go to the company and I say, you will fix it. For example, a financial institution. If not, I will go to my seller, I will take my nuclear bomb and I will hit it at you. He never had to use it. What is even more, simply because of the threat of using that nuclear bomb, companies, for example, financial institutions, when they are confronted with a collective problem, they go to the ombudsman and say, look, this is our plan, please help us to implement it. Again, an example of that division, blurring division between public and private enforcement. The leitmotif in the Representative Actions Directive is the division between domestic representative actions and cross-border representative actions. A domestic representative action is very easy. It is a qualified entity, and for the record, these qualified entities need to be accredited by their national member states. For example, an Italian consumer association, what it's called Altro Consumo, that brings a class action in Italy before an Italian court, that is a domestic representative action. Suppose that Altro Consumo wants to bring a case in Germany or in France, or God forbid it, in Belgium, then it is a cross-border representative action. And this is the leitmotif in the Representative Actions Directive, because in the beginning you couldn't find that, and there was a lot of criticism that a lot of these mass cases, also in the financial sector, are of a cross-border nature. They have customers in all kinds of countries, and then it has this cross-border dimension. So this is, I mean, the first aspect, courts, collective actions, representative actions. Now most member states are in the phase of implementing the directive. They should have done that by December 22. I think only 4 or 5 did that. They all received a very angry letter from the European Commission saying you have to implement the directive, but it is a very controversial problem, a difficult problem, because it also, the biggest problem is the funding and the financing. There's a big discussion now regarding third-party litigation funding. You now see a lot of these funders being created in Europe, If, for example, the American lawyers have smelled the money and they are using funds in the US to set up funds here in Europe to explore the market. For example, some of the Volkswagen litigation is sponsored, funded by a lot of these American law firms. So it's a very complicated issue, but I also think in the context of the payment services financial sector, this is something that we will see thriving in the coming year. This is the first thing. The second thing is ADR, alternative dispute resolution, and this is explicitly mentioned in the Payment Services Directive in the sense that Chapter 6 focuses on ADR procedures for the settlement of disputes. But what is interesting is that the Article 102 of the directive explicitly refers to the Consumer ADR Directive of 2013. And that Consumer ADR Directive of 2013 is also in this context, I think, important and will become much more important because, as I mentioned before, or maybe I didn't mention it before, I'm confusing it with my talk 2 days ago, and sometimes I'm a little bit confused what I have said and what I have not said, is that the European Commission is now revising the directive on consumer ADR. In the summer, now in July and August, the European Commission will publish its consumer enforcement package. There will be a revision of the CPC regulation, the Consumer Protection Corporation regulation, and also of the Consumer ADR directive. And last year, at the University of Leuven, we drafted a report for the European Commission in which we have made some proposals to do. And one of the proposals that the European Commission was particularly interested in was collective ADR, also in financial disputes. So, you know, in the financial sector, you have a number of countries, and I think in most countries this is the case. For example, in Italy, where you, for example, have the Banca d'Italia, you have financial ombudsman, financial ADR schemes. What the European Commission wants to promote, not wants to oblige, but wants to promote, wants to facilitate, is forms of collective ADR. And they use that, and that's why I'm a little bit sometimes surprised now by the current consumer policy of the European Commission. This morning, I think the person who chaired the session this morning said, sometimes you have the impression that if the European Commission does something with one hand, they don't know what the other hand is doing. Regarding the consumer policy, I have not that impression. I think they have become smarter. I don't know. Maybe the water in Brussels is more healthier now. I don't know. But they are looking at these things and they know. They will not say that. They will not explicitly say that. But my idea is that they know that these representative actions will probably not flourish as in common law jurisdictions. And I think they're working on plan B and they're working on plan C. And plan B is collective ADR, collective forms of ADR. And I think this is something that I think we will see also in the forthcoming revision of the ADR directive. The last one, the most controversial one, the most difficult one, has to do with public enforcement and with what Olga called hybrid enforcement. I will haunt you for the rest of your life with that term, but what I have called for many years, regulatory redress. Not me, I did it together with a very good friend of mine who some of you know very well, is Chris Hodges. In 2018, we published a book on new technologies for collective redress, and one of the aspects we looked at was regulatory redress. And at the outset, you have regulators, public bodies that investigate what companies do, for example, financial institutions. When the financial institution or the trader does something wrong, they do an investigation. If they think that the trader really did something wrong, they take a very big stick and they hit on the head of the trader with a very big fine. And that's what they do. That's the only thing what they do. But if people have suffered damages, customers have suffered damages, again, it's up to them to individually pursue their claim before a court or to do that collectively. What is regulatory redress? Regulatory redress means that the regulator also pays attention to the redress of the consumers, of the customers. And on the slide, you can see a number of examples that we have discovered. For example, the Banca d'Italia does that. It's called specifiche forme d'offerta. And specifiche forme d'offerta means that if the Banca d'Italia comes to the conclusion that the bank did something wrong, they can issue orders to redress. They can oblige the financial institution to pay back everybody. The best example, and you already mentioned it, is the UK. In the UK, you have what is called the Regulatory Enforcement and Sanctions Act, which was amended in 2000 or 2002 by the Consumer Rights Bill, which expanded the toolbox of these regulators in the sense that they could adopt that regulatory redress technique. And what you see with some of the regulators, for example, Ofgem, they only do that. They don't use the stick to hit on the head anymore. No, they order the company to pay back everybody that suffered damages, and then they determine the fine in light of what the company paid back. Even the European Commission did that. There's a famous case, nobody wrote about that. It's the Deutsche Bahn case. Deutsche Bahn owns all the railroads in Germany. They don't use them, all of them. Other companies can use what is called, I have no idea what it is, the traction current of those railroads. The European Commission discovered at one point that companies that were member of the Deutsche Bahn group paid less money for the traction current than companies that didn't do that. So the European Commission said, you cannot do that. We will take the stick and we will hit on the head. Deutsche Bahn said, we're very sorry. Mea culpa, we did something wrong. We will pay everybody back, and this is the plan that we will do. And Deutsche Bahn submitted a plan for 4 or 5 years in which they gave a discount to all of these companies. Everybody was paid back, and the European Commission said, okay, let's try. After 4 or 5 years, everybody was paid back, and then the European Commission had to impose a fine. You know how much the fine was? €1. That's what they did. Now, that technique of regulatory redress sounds fantastic, but also has some caveats. A lot of these regulators will say, we don't have the resources, we don't have the means. There's also the problem of political capture, because you have these public bodies. In the UK, for example, this is regulated in the sense that these enforcement policies need to be published. You also have recourse to the courts, etc., etc. But what is interesting is that it was almost laid down in the CPC regulation. During the last revision, there was a lot of people, guess who lobbied for that? The lobbyists who hate class actions. And they said, class actions, it's terrible, terrible. We need to have an alternative, and this is brilliant. During the legislative process, it was killed by Germany and France. Germany and France says this is completely nonsense. This is not a core task of regulators, and we will find a compromise. And what is the compromise? It is based on the fact that traders can voluntarily take an initiative to pay back people who suffer damages, and then the regulator can take that into account for the fines. But I do not exclude that in the forthcoming revision of the CPC regulation, that this will come back again, not as plan B, but maybe as plan C. Final point that I want to make, from a procedural point of view, from a dispute resolution point of view, it's very interesting to see the developments in all of these different boxes, court procedures, ADR procedures, public enforcement. But what is as important, what is crucial, is connecting all of these dots, is to integrate all of these dots. And I think this is also something that you see a lot of experimentation in a number of countries. Again, I refer to my very nice neighbors in the north, the Netherlands, where they are experimenting with that. And what is now, and I have to say, Olga, they copied that from me. I was a little bit angry because for many, many years, one of the things that I have written about is the prejudicial question technique. You know what prejudicial questions are? If a court has, for example, a problem of an interpretation of EU law, then the court can ask a prejudicial question to the Court of Justice of the European Union. In other countries, this also exists. In Belgium, you can ask a prejudicial question to the Constitutional Court because courts cannot do judicial review. In the Netherlands, since 2012, they have a general act that allows for that. One of the points that I have been arguing is in the context of ADR, when an ADR body is confronted with a collective problem and there is an issue of law, it's not up to the ADR entity to decide what the issue of law is. That is a prerogative of the courts. But what a lot of ADR entities will do, and in Belgium there was a financial case where the ADR entity said, the law is unclear. We cannot resolve that. So you have to go to court. Bye-bye. What the solution could be was that an ADR entity could ask a prejudicial question to the court. Everybody declared that I was completely cuckoo. The Social Economic Council in the Netherlands 3 weeks ago made a new proposal. What was in the proposal? A prejudicial question for ADR entities. We included it in the report, and maybe the European Commission will also use that. I don't know, in the in the forthcoming revision. So all of these are examples, again, and in that sense, I think the circle is round. Also, in the context of financial services, is that regarding the enforcement aspect, you see that the wall between public and private enforcement is crumbling. And I do think, for example, for policymakers, for academics, for researchers, I think it is important that you have to come out of your box and you have to start to look over the wall and see what is happening there and to connect all of these dots. This is basically the point that I wanted to make. So, mille grazie for the invitation and thank you so much for this.
Mille grazie to you, Stefan, for this very last, but not least, presentation. Considering that civil law was largely inspired by Roman law, we are happy to be the father of civil law, but we know that we have some problems, some issues with the enforcement of law, especially before tribunals. But we discovered with your help that we can have a hope using ADR and regulatory redresses. So happy to know of those alternative ways of enforcement that can be effective in order to protect rights. And now I'm happy to give the floor to... Yes, good, very good idea. There is time for questions and answers to the panelists. Oh, a lot of hands raised, so I'm happy to have all this debate before the conclusive remarks of Professor Andenas. Unfortunately, if the connected people would like to listen to your question, you should come here. If it's possible, first of all, our distinguished speaker, Professor Benjamin Jeva. You have a question? Yes. No, because sorry very much.
Yeah, no, it's not so much a question, but rather something from the Canadian experience, which was mentioned, but there are two aspects that I want to add, which are kind of, well, in a sense, show some problems. For one thing, in Canada, what was established also was the ombudsman for the banking system, which supposed, again, the idea is that many of these disputes are of small amounts and the ombudsman could resolve it. But what the legislator forgot to say, that the ombudsman should give reasoned judgments. Because what happens is that, well, you see their annual report, they will say there was such and such complaint, we solved such and such, everybody's happy, goodbye. But they don't establish, if it would be case law, there would be established principles, and then we would know. But all these questions now can repeat the next year or with a case to case,
and you wouldn't know. So it's important for that there will be transparency, and that the arbitrator, ombudsman, etc., should, excuse me, work. Not just, so that we'll all be able to benefit, including law professors that want to assign 6 cases to students if you don't know them, but that's a different point. The other thing is on the negative side, what an issue which came up in Canada is that very often you do have a situation that the amount is de minimis for each individual consumer, but then when you assemble them all into a class action, you get a huge penalty on a bank, which maybe they deserve it because of but then the question of how to distribute it and all that does create something which again costs money, and then the question is what is the utility, which begs the question if it is not a heavy administrative penalty would not be enough, particularly in cases where you couldn't blame the bank, so to say, for negligence. There was really, the law was unclear, and as I say, the damage to each individual consumer was pretty much de minimis. I'm not sure how exactly you can put it into all the equation, but I think that this is something that has to be taken into account in terms of the overall, in the overall distribution, because of course what very often happens, and I don't have to tell, that the action is not even initiated by consumers, but there is some law firm that say, hey, we do have a brilliant situation, we can here now collect such and such millions from the bank, such and such percentage go to us, and the rest, who cares anyway? So the longer and then after years, you get if you are involved in this class action, you get, well, here is your portion, $20, or I don't know what, or something like that you might as well forget about it. So, but the dilemma, of course, you don't want the banks to give them license to say it's only $20 to each one, and I think that administrative penalty with blaming them would have been in such situation good enough. Thank you.
Regarding the last point, you're making a very good point. I mean, and the situation in common law systems in the US is completely different than in European systems. In the sense that in common law systems, if you look at class action law, there are 3 goals in class actions law. It's collective access to justice, it's procedural efficiency, and it is deterrence and behavior modification. The last one focuses on public enforcement. And in the US, for historical reasons, there's not a lot of public enforcement. So over the course of the years, private class actions have been utilized as forms of public enforcement. It occurred in the 60s in the US, where you had a lot of case law of the Supreme Court giving substantive rights to minority groups. And these minority groups suddenly received those substantive rights, but they could not enforce them. So what they did, they amended Rule 23 of the Federal Rules of Civil Procedure, and then they started to use that system. But then they also started to abuse that system in the sense that you have described, even what are called the portfolio lawyers that had secretaries on every floor. They bought shares of every companies. Every morning they looked in the newspaper, which company now has a problem. The secretary on the 8th floor has a share of that. She will be the class representative. We will bring a huge class action and we will make a lot of money. That is true, but there's also a lot of empirical evidence showing that that image is much more nuanced. There was a lot of, there were some legislative efforts. For example, the Class Action Fairness Act, the Private Securities Litigation Reform Act, that wanted to curtail these abuses. That's on the common law side. On the European side, the European legislator has said from the beginning, since the 2013 recommendation, that private class actions cannot supplement public enforcement. So if you have a company that is the object of a public enforcement process, first that process needs to take place, and only when there is a violation of the law, then you can bring private class actions to claim compensation. of course, another good point that you have raised is regarding the distribution of these damages. This is not regulated. In common law systems, you have the system of Cypress, of fluid recovery distribution, in the sense that the goal, if every individual customer of the bank suffered 10 euros, okay, and if you all add it up, then the bank made an illegal profit. You have to skim it off, that illegal profit. You cannot say, okay, the bank can keep that. The second question is then how do you distribute that? I do think under the theory of Cypress, you don't really have to distribute that among the consumers. I mean, the most important thing is that you can take away that illegal profit. Then you can put it in a foundation. You can put it whatever. You can put it like in Ontario, I don't know, an access to justice fund. In Israel, you have also the same sort of public fund where you use that. So, I mean, this is true, but I think the picture, the image in common law systems is different than on the European continent, in the sense that these private class actions are not, a supplement for public enforcement mechanisms.
Well, I have a quick Gabriela and Stefan. I think to Gabriela first. I think you've raised an interesting point as whether it would be whether it would be useful to consider additional obligations for payment service providers in terms of vulnerability checks. I think that it could be. This is not entirely new in a way, because we have, for instance, very extensive obligations already in the area of investment services when it comes to the appropriateness of a particular service and suitability to clients. So, and even in the case of execution on the services, investment firms are supposed to check the knowledge and experience of a customer in the investment services field. So, would that not be perhaps interesting to look at in exploring this idea of what extent we can learn maybe from other fields where, because the MiFID tool itself is not really using the terms of vulnerability, but it has developed a very, I think, sophisticated client classification, and it has introduced a high level of protection for retail investors who can be both consumers, also small businesses. It could perhaps be an interesting case to look at.
Yes, I fully agree. I fully agree. MiFID should be. I should consider MiFID and MiFID conduct law rules, but we should also take into account the differences in terms of the type of services and the risk raised for the. So we should.
I think that the reason why perhaps has never been considered in the context of PSD2, because payment services were to be much safer than investment services. But now we see that with the increasing complexity of technologies, the complexity also increases payment services. And my second question to Stefan. Well, I will definitely think about this term regulatory redress. I think that's a very interesting way also of talking about hybrid enforcement. But I have a question on the use of ADR for the purposes of collective enforcement, because this is, I think, a very new idea, very interesting, and I think the advantages are clear, increasing the effectiveness of collective redress. But what about disadvantages, potential weaknesses of that approach? And I was thinking about, mentioned also this point about the legal framework that ADRs are applying. And in the Netherlands, for instance, the KIFID, our ADR body for financial institutions, it is following the Dutch Supreme Court, and it tries to follow it as far as possible. But in the UK, for instance, we have the reasonableness and fairness. I think the stakes become higher once, collective action is launched, and in terms of certainty, how can we resolve?
It's a very good point that you are making, and what the Commission will do in the directive is to enforce. They will drop probably fair and reasonable, because you cannot use that in that context. And they will reinforce the legality requirements. They will also enforce, for example, because some empirical research has shown is that in ADR, the natural persons that are doing the ADR have too much creativity. And what is the goal? But that's the advantage and at the same time disadvantage for ADR. If you have a consumer that is using ADR, okay, it has to be a decision according to the law, or is it okay if the consumer is happy? And what you see now in a lot of ADR entities, well, as long as the consumer is happy and the trader is happy, but it's contrary to the law, we don't care. But this, of course, does not work. First of all, I think in individual ADR, but also in collective ADR. And this is something that, the discussions I had with people from the Commission is that they want to tackle that. And they really want to make the threshold much higher. If, for example, especially also in light of a lot of case law of the Court of Justice of the European Union regarding mandatory consumer law, which also in the Netherlands have given rise to a lot of problems. But both things go hand in hand, and of course it makes sense that if you do collective ADR, that I think this is important. But also what Benjamin said, if it's an issue of law, let me be very clear. I do not think that you can have an ADR entity or an ADR system, besides the fact that the systems are very different. In some countries, you only have mediation, conciliation. In the Netherlands, you have quasi-arbitration. This is not up for ADR entities to do that. But in that sense, that other technique that I mentioned can be a possible solution. But I completely agree with you. But this is something that, hopefully, that's what I told them to do, that will be looked at the new forthcoming revision of the ADR directive.
Just a short comment on Professor Pozzolo's speech. This morning, Professor Sarmiento spoke of level playing field. Issue is that when it comes to banks and, let's say, new players, data companies, there is not a level playing field in the area of data processing and protection. In the sense that the banks can use the data of their clients only for those purposes which are specifically have been given to them for those purposes that they have approved. While when it comes to data companies, whose business is that of profiling, and they spend their time profiling, clearly they do something with completely different use. So there's no the kind of wealth and of economic value, the information, the good, which is, you mentioned information as a good, that good for the bank is worth, let's say, 1, for a data company is worth maybe 10, because it has much more possibility of processing this data together with other data, mixing them together, and having a much deeper knowledge of the client. So just to show you that, just to point out that from your argument, from your position, saying the good is information, well, information depends if you have it or I have it. If you have it, it's 10. If I have it, it's 1. So this is not, and this is a regulatory. It's a law that sets out this. The GDPR that establishes different rules. So there's no level playing field between these two players in the financial market.
Yeah, if I may reply, I fully agree. There are many instances of asymmetry or treatment depending on who is using that good and what is the value of that good. You can also think that the other way around, the kind of information that you collect if you are Amazon on the amount of the quantity of goods, the quality of goods that are bought, and so on and so forth. Can be extremely useful also for banks, which I don't think implies that bank can benefit from it, but that eventually Amazon will set up its own bank. The bottom line seems to me is that if you don't that into consideration very carefully, we're going to end up with very few, very large players, which is detrimental to competition, to welfare, and to anything that we normally teach to our students in economics. So I fully agree. Unfortunately, there are many, many dimensions on which this problem should be tackled and hopefully will be tackled.
Yes, please, Professor Everson.
Isn't the point that the banks did use their data? If we go back to financial crisis, not using the data direct, but in packaging the debts you have and selling them onto the market, you are using individual customer data. The reality was the banks cheated. They cheated. They cheated, yeah, and no one could see. You only see, I mean, for people in insurance, you know, how can you have a wristband without a median risk? You know, it's insane. It's insane. But they, you know, by selling risk packages, they were putting that data out onto the market. That will be, you know, the banks have used data. That, of course, results in a new financial system, and we get credit rationing. Because, you know, how do we solve the problem of the banks cheating? We stop people who don't have any money ever getting credit. That's how we solve it. So we get the, and what I find, I mean, I'm just playing around with ideas, but what is so attractive about the platforms, of course, this will be a move to readdress that credit rationing construct. If you have so much data out there that you can actually begin to get, is that a possibility, products into the people who normally would be excluded from the market? I may be wrong, just a question.
I don't want to get too much into the financial crisis because, I mean, who eventually bought those opaque products were not uninformed customers, but that's a different issue. On the use of information, I mean, there is a literature in economics that studies very carefully what happens when you have a lot of information, and it's not always the case that this is welfare improving. Because when you have a lot of information, eventually financial intermediaries can better discriminate across different customers, which might imply that some customers turn out openly not to be worth having a loan. While when there is more opaqueness, you have a pool in equilibrium, what we call in game theory, and in that case, some customers that otherwise wouldn't get credit can get credit. And it seems that actually this extremely precise description of customers is more going into the first outcome, where you have more credit rationing than towards the second, even if in the end it's very much an empirical question.
May I ask a question to Marta, to Professor Beres? Can you hear me?
Yes.
So, during what kind of a role may the supervisory authority play in order to bridge MiCAR and PSD3? So what type of role they can perform to make it easier?
But are we talking about supervisory authorities at the European level? So this
yes,
is
European level, yes.
I can see Dick Hubrick shaking his head and saying, "Well, I'm not sure if they can actually. I'm not sure if they can actively form this bridge between the PSD2 and the MiCAR, but in the sense that they do have the ability to issue recommendations, guidelines, and opinions. And in this sense, they can help to fine-tune some of the misinterpretations or some of the ambiguities that are currently exist between the MiCAR and the PSD2. For instance, I saw in the Commission's report on the effect of the PSD2 that there were also some calls for, well, some national competent authorities called for the merging of the second electronic money directive and the PSD2 so as to have this more coherent approach to electronic money and to electronic money and funds, but this was of course discarded. So I think that supervisory authorities cannot actively build bridges, but they can help fine-tune the conceptual ambiguities within the two legislative acts. Perhaps I'm not sure what the EBA thinks about that.
Yes, I think it's a very interesting question, but has a very complex answer. I think, Marta, what you said, I think is probably in the right space, but it's slightly more complex, for lack of a better word, because yes, the EBA and also national authorities, we can bring about, we can issue guidelines, and the importance of guidelines and the fact that we can issue them on own initiative has recently, last year, been confirmed by the European Court of Justice in the case of the so-called POC guidelines, Product Oversight and Governance Guidelines, which the French Banking Federation has brought to the Court of Justice and has 110% confirmed that the EBA was right in issuing those guidelines. So we can do that indeed, but what we cannot do, just in case anyone is under that illusion, for just to use a bit of a provocative word, is we cannot change definitions that are set out in level 1 texts, okay? And level 2 texts, so-called technical standards, we can only issue if we have been mandated to do so by the legislators. We cannot on our own initiative issue technical standards. We have to be mandated to do so. So the most forceful type of legal instruments that we can issue on our own initiative, if we see certain issues of consistency or on conflicting definitions, are guidelines. But even in those guidelines, we cannot change definitions that have been set out in level 1 text. That is just legally not possible for us. We do not have the power to do so. What guidelines are meant to do is to provide further details in how a particular provision in level 1 text should be complied with by financial institutions and or national authorities. But we cannot go beyond that.
Thank you.
Thank you very much. I'm really very happy, and speaking also on behalf of Maria Cecilia, that the discussion was so interesting, and also this debate among the speakers of very high level, technical level. So really happy to give the floor even a bit late, but there are still people. There is a student raising the hands for a last question, but probably it's a little bit too late. So you can take the questions. Oh, you may. You would like to come here for a question, last questions. Very quick because time is running, but it's beautiful to have a student that would like to raise a question.
Sorry, I'm late for giving you my question, but I'm the student here from Roma 3, and my first question regards the MiCA regulation, and it's quite simple question, and it regards whether we are going to expect from the MiCA strictly public enforcement or a hybrid one, just like you said earlier. And the second question regards the just like you say, the age is not the sole criteria to establish whether a person is vulnerable or not. And there is also a very, at least in Italy, I noticed that among my peer colleagues in university, there is a very low level of financial education. So is there any possibilities that the EU can do to promote financial education within member states?
Very much. Who would like to answer those two questions? Gabriella, thank you very much for this.
Answer the second one about the education, the financial education. I know that there is a program launched by the European Union to support financial education throughout the member states, and many projects about. But it depends on how the project have carried on. and finalized. So this is so financial education takes time. That's the problem, like any form of education.
For the MICA, there is still, but I promise you that at the lesson, because it's one of my students, I'm very proud of that there is the need. We will discuss this point about MICA in our next lesson. And then I'm very pleased to give the floor to Professor Mazandenas, that is a very well-known academic, especially for his work in the fields of comparative and international law, and he also has published a lot in the banking regulatory field. So I'm happy to give him the floor for concluding remarks of
Many
this.
thanks. Many thanks. It's been a great pleasure to be here. And then usually when you ask to report, it's a way of keeping you awake. Now, today I didn't need that task because it was very difficult to do dead points. And we have been working ourselves towards the PSD3. We looked at dynamics of digitalized payment services market, and Vincenzo Zenkovic explained or set out 5 points when we started. It was what are data markets, financial data, should they be host, and as a strategic resource, and that was really banking, one core aspect of banking. And the second point he made was that there's a fragmented approach and not totally consistent approach by the Commission. Example, digital market, and then of course I think Stefan Wood said that everybody's getting smarter, also the Commission, and then but the image of Kali, with many hands, and on the other hand, and one hand doesn't know what the other doing. That is a good image, because Kali has many hands, more than hands, and so has the Commission. And private lawyers know that private law is one of the has been confused. One Directorate General, or sometimes even one unit, subdivision, one set of terms in one directive or regulation and another, and certainly if you move of level, terminology or approaches, and they also have disagreements. Should you acknowledge private law? Should you look at remedies? Many people who work their lives with regulation are not that interested in remedies or central bankers or banking regulation in general. See that as a problem when you're looking at prices and cases that came, and also the possibility of different the approach of the central claims are now such big claims. Basically, in an ideal world, these consumer deposits would disappear because they are not helpful. So the point is just that you can't say that regulators or even people working in the Commission have the same view on the basic policy matters, because it depends on what is your brief, what is your ability, and that affects issues such as those we discussed throughout today: remedies, private parties, depositors, market payment services. And then as I say, continued with home banking, how everything became digital from physical representation, a digital area, and moved on then also with the role of digital currencies and the role of private parties, and raised the question central bank, which then Benjamin Jiva followed up, not in his paper, but in the question session afterwards. Then I understand Jiva then as an ideal world, you could very well have a digital currency by a central bank and doing away with many of the services providers you have in payments and which may not then be necessary. And I could come back to that in a while. And then Zeno Senkovic mentioned new systemic risks. And of course, he also answered that halfway because he said, yeah, yes, of course, there are, but the risks we have seen materializing recently, the most classic kind, about liquidity. So could be that the new markets increase certain risks, but on the other hand, these are not new risks, and they're not risks which central banks or regulators are unprepared dealing with. To the contrary, which are in their caution the way they, and they just have to perhaps just stop. And then Ola Shednichenko's paper had lines followed up, if you like, in Pieto's paper and Liano and Stefan Wort's papers, and of course it was the distinction between private law and law that when you are dealing with private law generated by the European Union, you always have to have it in the core aim of creating a single market, effectiveness of community law, but also the standard of conduct which has come in, and relating to that different investor, consumer, depositor. And I thought the juxtaposition of PSD2 MiFID was particularly interesting. Slide where you show that here we had two individual liability rules, and you had a public-private law grammar, public and private law. As MiFID didn't have any civil liability rules, and we know that that went in and out of the at the last, and that has left us with primarily a public law grammar, but with conduct of business rules, which at least will have an impact on that, although there will be dispute as to how much they belong in a public law sector. And then I thought that I love to hear Stefan Wood refer to Gavin, who is was one of the smartest ever, I think, and I agree with that, and I also think he's one of the nicest man ever. And if it's the tort law book from 2001 you are referring to, then of course it's a remedies book. It's not about substantive community, it's about remedies, and it's about, if you like, effectiveness of community, and something which many community lawyers have not been that interested in, and particularly people who work in our area, financial market, be more interested. Here's the model. This is how it will work. And of course, the enforcement is how do you resolve it? Make sure that it works, or that is something which is a conversation. And here, of course, talking about payments services, we have an interesting, and it's obvious why. And I think what I mentioned that in many ways, payments was organized, moderately contained in terms of risks and protection of different buyers or users. And then you show that actually some areas, for instance, has moved ahead in terms of customers. Now, I always I think a bit about why have we. So still, I think we have come further in payment services than in practically any other area of Europe, and most certainly in. And I wonder if one of the starting points, a little unrelated to the second, is cross-border payments. It was such an obvious thing. If you were concerned with the internal market and the functionality of the cross-border payments dealt with, it was completely irrational that you had to pay 10 times as much in fees if you sent money from England to. So that was resolved. And then I think the second factor, which is the role of central banks. Central banks have always seen payments as a core at the core of their mandate. And then when you got the ultimate harmonization measures for currency and the European Bank, that the European Central Bank continued to take a lead in cooperation on payments issues. It's these different factors which work together and created the situation we have. And that means that payment services is an extremely useful area to study for us when it distinction between public and private law and commercial law in general. How you should develop remedies and collect actions. Well, there payments. But again, this idea that we have regulation which aims at market, which has focus, that it goes in and regulates private rights in the way that you do. Payments area can be helpful. Now today we have talked about how you could go on other areas of community law, other regimes in terms of resolving problems in the payments sector primarily. And of course, what this is not about is how you could do it and that is of course a good topic. Now there were so many really fascinating issues I would have liked to take up. So if you would allow me another half an hour, I would of course no. Then I will do it. Otherwise, I'm really. You say I should just go on for another half an hour. You insist. I mean, Michelle insists that I go on for another half an hour, and in order to satisfy Michelle, I will then go into a bit further development of her paper. Thank you very much. And of course, congratulate you and you, of course, this excellent conference.
Maria Cecilia, come.
On, Cecilia.
Just to really thank you very much.
And I should have said something more about Cecilia's paper, but that will be left for some written discourse later on. Cecilia, this is an excellent paper.
Yes, we would like to thank together, and I give the floor to my colleagues, really, that we are very happy of this fruitful discussion, frank, sincere, a real academic discussion in person. I'm very happy that we managed to do this because, of course, in person changes a lot. And also to establish academic and theoretical discussion, relationships is, I think, is at the heart of our job that are professors of law or economics in this case. Please, thank you very much.
No, I don't have too much to say to add to Concetta. We are very happy. It has been a huge work for us, but we are very grateful to everybody for being here and to Michela Mastrantonio who helped with the organization.
And Federico too.
Yes, of course, you too, yes. And so, thank you everybody, see you soon.